I can start.
Yes, sir. Good evening, all. Welcome back to our ongoing session on direct taxation. We have CA Muthu Palaniappan sir here. So let's continue our collaborative journey towards the success.
I can start.
Yes, sir. Yes, sir. Good evening, all. Welcome back to our online.
So yes, so good evening, all of you. So welcome back. So we are in the second day of marathon session. I have one more day. So we absolutely have 3 modules in this direct tax syllabus, and we already covered the first module, and we also covered about the salaries, right? So we covered about the first head of income. So what we are going to do today is going to cover the rest of all the 4 heads of income today in a brief amount of time. So of course, the next head of income is your house property. So when you say house property, we all know that it is about. So we all know that it is about your rental income of your house property. So basically the structure of house property computation will be, you'll start with gross annual value, whatever is municipal taxes needs to be reduced. You'll get your net annual value. From that, you have a couple of deductions. So first deduction is 30% on the net annual value. And then you also have deduction on interest on borrowed capital. The resulting number is your income from house property that will be taxable under section 22. So this is what is the computation model for house property. So this is what you have to follow in your examination. So now we'll understand each one of them. Of course, first we have to understand the gross annual value. So to know the gross annual value, we're going to take, so to know the gross annual value, we're going to take the expected rent versus actual rent. So there is one concept called expected rent. There is another concept called actual rent. What is expected rent? It is higher of fair rent and municipal rent. So higher of fair rent and municipal rent restricted to standard rent. So basically you have fair rent and municipal rent. So out of this, whichever is higher you take, and then you compare this with standard rent, and here you take whichever is lower. So fair rent or municipal rent, whichever is higher, subject to maximum of standard rent, and that gives you your expected rent. And what is your actual rent? Whatever you have received as rental. But when you say actual rent, you have to remove whatever is unrealized. So whatever is unrealized needs to be removed. So as far as unrealized is concerned, you should prove that you have made decent attempt to collect the rent, but still not able to collect. And that tenant is not owning any other property of you. So the owner, the tenant relationship is only for this property, it's not for any other property. And the owner has taken the steps to vacate, and he has also taken the steps to proceed with the legal proceedings. So that is your actual rent. So the expected rent or actual rent, whichever is higher. So the higher of these two will be called as your gross annual value. So as I told you, expected rent is covered from this fair rent or municipal rent, whichever is higher, subject to maximum of standard rent. So this is how you calculate your gross annual value. Once you have calculated your gross annual value, you have to keep certain things in mind. So though you have a gross annual value, sometimes you need to understand why is actual rent less than the expected rent. We said actual rent or expected rent, whichever is higher. So we need to understand why is actual rent lesser than the expected rent. If your AAR is lesser than ER because of vacancy, which means you are not able to rent it out, then even though it is lesser, the AR shall be the gross annual value. This is the first situation. What is the situation? Your property was vacant for part of the year. So which means just because your actual rent is higher than the expected, is lower than the expected rent because of vacancy, even though it is lower, you are still taking actual rent as your gross annual value. And then what about your self-occupied or unoccupied property? That is throughout the year. The entire 12 months, it was not available. It was not occupied. It was not let out. It was not self-occupied. It was self-occupied. So in that case, the gross annual value shall always be nil. And the conditions is maximum of 2 houses. So one assessee can use up to 2 self-occupied house properties. So one can be his own residence, the other can be for his parents also, doesn't matter. So what do you mean by self-occupied? It is kept for your own residence or for the purpose of not occupying it. And this is only applicable to individual HUF. So when you say self-occupied property, this is applicable only to individuals in HUF. And when you are occupying it for your own purposes, there is no concept of municipal tax, which means you cannot reduce municipal tax. Very simple reason. By reducing your municipal taxes, what happens? Your gross rental, your gross annual value becomes becomes negative. So that is why you're actually saying that gross annual value minus municipal tax will become your net annual value. When you're self-occupying it, there is no gross annual value, which means you're reducing municipal tax. Your net annual value becomes negative. Your net annual value cannot be negative. So municipal tax is not allowed for self-occupied property. And what if you're self-occupied for part of the year and part of the year it is let out? The third situation is partly self-occupied, partly let out. The rule is expected rent should be considered for the whole year. Expected rent should be considered for whole year for the purpose of gross annual value, even though it is partly let out. Even though it is partly let out, the expected rent should be for the whole year. And the expected rent versus annual rent should be compared. Expected rent is for the whole year. Annual rent is only for the let out period. The actual rent is only for the let out period. If it is let out for 4 months, the actual rent will be for 4 months, but expected rent will be for 12 months. So expected rent or actual rent, whichever is higher, expected rent is for full year, whereas your actual rent is only for the period that it's let out. Even though it is only partly let out, the municipal tax can be considered for the whole year. So this is how you calculate in the 3 different scenarios. Vacant, you consider actual rent, even though it is less than expected rent. And what if it is self-occupied? You can occupy up to two properties as self-occupied. So the gross annual value will be nil, no municipal tax. Third is partly let out, partly occupied, self-occupied. In that case, expected rent is for whole year. Actual rent is only for part of the year. Municipal tax is also for the full year. So these are the 3 situations where the gross annual calculation is slightly different from what we already saw in the earlier slide. So this is how you calculate the gross annual value for these slides. And moving on, there are also other cases where deemed to be let out. Deemed to be let out is, we said that there are only maximum of 2 houses that can be called self-occupied. So which means you're occupying 3 houses, one for yourself, one for your parent, one for your in-laws or someone. So when you're occupying 3 properties, maximum that can be considered as self-occupied is only 2, which means the third property should be considered as deemed to be let out. What do you mean by deemed to be let out? Even though you are not receiving any rental, automatically you have to calculate the rental value. So what is the rental value? It will be expected rental. So ER, because there is no actual rent, there is no AR. So ER automatically becomes your gross annual value, and you can also claim municipal taxes. So it is as assessee's discretion. So out of which property should be deemed to be let out, which property should be self-occupied property, purely it is at your option. So you have to calculate the net annual income from house property for all these 3 houses, whichever is beneficial to the assessee, whichever is beneficial. So whichever is beneficial will be treated as self-occupied, rest will be called as deemed to be let out. So it is based on choices, self-choice, there is nothing else. And what if a particular property is held as stock in trade? Usually the annual value will be nil, the gross annual value will be nil, but it is not for eternity, it is only for 2 years. So for the first 2 years, it can be treated as on the completion certificate. For example, I am into real estate business. I've built a residence house. I'm not able to sell. For the first 2 years, I will treat that as nil. So self-occupied, it's like self-occupied property. But after the 2 years, from the 3rd year, I have to calculate gross annual value. Automatically, it has to be calculated as deemed to be let out. It's like deemed to be let out. And what if this portion is let out, portion is self-occupied? Earlier, we saw partly let out, partly self-occupied. Now we are talking about situations where portion is let out, portion is self-occupied. I have a ground floor and first floor. Ground floor is self-occupied, first floor is let out. So this will be considered as 2 independent units, as if you are having 2 independent residents. So 1 house, 2 house. Unit 1 will be self-occupied, unit 2 will be let out. So automatically everything will be proportionate. What? The municipal rent, the fair rent, the standard rent, the municipal taxes, everything will be on the proportionate basis. So that is what you do. So these are the 6 situations where your gross annual value is different. We already saw 3, where it is self-occupied, where it is partly let out, partly self-occupied, and in situations where your annual rental is less than expected rent because of vacancy. The first 3, the another 3 is deemed to be let out, held as stock in trade, and 2 independent units. 1 portion is let out, 1 portion is self-occupied. So all this is covered under your gross annual value. So these are different situations And as far as your property taxes, as we said, municipal taxes will be allowed deduction, provided it is borne by the assessee. If the tenant is bearing the municipal taxes, it is not allowed. So the owner has to bear the municipal taxes to claim it, and it must be actually paid. So payable is not allowed. Whatever is paid is allowed. Even property outside India can claim taxes, local authority taxes. So foreign municipal taxes also allowed. If a question talks about a property in England where you are paying taxes in England, for that also you can consider. So and wherever annual value is nil, you are not allowed to do deduction of municipal taxes for very simple reason. Net annual value cannot be negative. Net annual value cannot be negative. So that's what it is about. Unrealized rent, subsequently, when you're actually receiving it, it becomes taxable. So unrealized rent is subsequently taxable. In the year of non-receipt, we have already discussed the conditions. If these conditions are followed, then it will be called as unrealized rent. And what about the deductions? From the net annual value, we said there are a couple of deductions. From the net annual value, the first deduction is 30%. It's a flat deduction. So it's a flat deduction of 30% of a net annual value. Apart from that, you can also deduct interest on borrowed capital. So any loan, housing loan or any loan for the for purchasing the property, that can also be reduced. So how much of interest? So not whatever interest. So there is a restriction on the interest. So the interest on borrowed capital, we'll first talk about the loan purpose. The purpose of the loan can be for construction, repair, renewal, reconstruction, repay. So it can be for any of these, either you're acquiring or constructing, whatever reasons have been specified. So basically it should be for your house property. And then it is eligible from the year of completion. It is eligible from the year of completion. So till the year of completion, it will be called as pre-construction period. So I have borrowed loan in 2021. It is complete. The construction is completed in 2023. Interest from 2021 to 23 is pre-construction period. From 23, it becomes your actual interest. So what about the interest in 21 and 22? It will be treated as pre-construction period interest. It is very simple. Calculate the pre-construction period, divide it by 5, you claim it over a period of 5 years. So this pre-construction period interest is eligible for a period of 5 years. And whatever is the interest after completion is eligible as it is. And there is no restriction. There is no restrictions, no limit for interest on let out and deemed to be let out, because deemed to be let out also you are calculating a rental value. So the rental value could be actual rent or the expected rent, whatever it is, it could be let out or deemed to be let out, but there is no limit. There is no limit on the house property as such. Ana self-occupied nu varumbodhu, there are some restrictions. So when it comes to self-occupied, the restriction is 2 situations. In first situation, it is 30,000. In the next situation, it is 2 lakhs. When is it 30,000? When loan has been acquired before 1st April 1999, or if it is after 1st April 1991, but it is for movie like RRR. Remember it like a movie, RRR. So RRR stands for repair, renewed, reconstruction. If it is for these purposes, these 3 purposes, that is RRR, repair, renewed, reconstruction, then it is maximum 30,000. If it is for acquiring, if it is for construction, then it is full loan. Then it is eligible up to 2 lakhs. Then it is eligible up to 2 lakhs. So it is for acquiring or construction. The only condition is the construction should be completed within 5 years. Construction should be completed within 5 years from the end of the financial year in which capital is borrowed. And every year you have to have the financial certificate. How much of interest is being paid to the financial institution should be kept by you. So maximum of 2 lakh is allowed in this case of self-occupied. As I told you, there is no limit in case of let out or deemed to be let out. Both does not have a limit. And limit includes pre-construction period. So when you say 2 lakhs, when you say 30,000, it not only includes your current interest, it also includes a share of pre-construction interest put together only. And interest is allowed on accrual basis. Please remember, municipal taxes is allowed on payment basis, but interest is allowed on accrual basis. And interest on unpaid interest, which is like in the Kanduvati, Ranvati Mari, like interest is charged on interest. Interest on interest is not allowed. The original interest is allowed. Interest on interest is not allowed. It's not allowed or deductible. And whatever unpaid purchase could also be treated as capital borrowed. What is unpaid purchase price? I'm buying a property for 60 lakhs. I'm paying 40 lakhs, balance 20 lakhs. I'm telling to the seller that I'll pay it in 2 years. So for the next 2 years, this 20 lakh is like a loan. So when I'm repaying it, this 20 lakhs along with that interest for 2 years, will be considered as borrowed capital only. So that is also borrowed. And whatever it is, overall interest cannot exceed 2 lakhs in case of what? In case of self-occupied property. There is no limit in case of let out and deemed to be let out, but there is a limit in case of self-occupied. It is 30,000 for old loans or RRR. Most of you would not have been born before 1st April. Most of you would not have been born before 1st April 1999. So all those before 1st April 1999, those loans are not allowed. Only 30,000 is allowed. And similarly, RRR, repair, renewal, and reconstruction. These are the key things that you need to keep in mind when it comes to your deductions under your loan deductions, interest deductions. And what is not admissible, there are certain things called as inadmissible deductions. Basically, when there is interest payable outside India, when I borrowed loan from outside India, I need to pay interest on which I have not complied with TDS. If there is non-compliance on TDS, then automatically I cannot claim that interest. However, for exam perspective, you can skip this. Arrears of rent is important. Arrears of rent is very simple. It is taxable in the year of receipt. You're still allowed 30% of rent receipt. And please remember, it is taxable even if you're not owner of the property at that point in time. So what matters is you have received rental for some old period. At that time, you are the owner of that property. At that time, you had the right to that property, but you did not receive the rental. You are receiving it today. Today, it is taxable. At normal, whatever it is, you can claim standard deduction of 30%. So this is still allowed. So that is all about your house property. So I don't think no one had completed house property in such a short time. We have completed the entire house property in 15 minutes. We have only covered whatever is important for your examination and whatever is relevant for your examination. So with that, we have completed house property. So we'll move on to the next topic. What is the next topic? It is PGBP, profit and gains from business or profession. PGBP is a very vast topic. Of course, it is very important when it comes to your final. You will have a lot of deeper understanding of the same chapter in your final. I'm sure you'll be going through it in the next few months or probably a year or so. So PGBP is what is more important for final, which is deeper. But in intermediate level, it is still important to an extent. So what are you going to do? We are going to go to that extent alone, whatever is required for your examination. So we are going to start with the deductions. We are not going to talk about section 28. So PGBP starts with section 28, which is called a charging section. There are various incomes that are listed. We are not going to cover it at this point in time. We are going to start with the eligible deductions. As far as your PGBP goes, the PGBP problem will be something like you will start with net profit, right? Net profit. So you will start with net profit. From net profit, you have to do 4 additions. 4 additions. I'll divide it into 2 and 2. 2 for expense, 2 for income. Okay. 2 for expense, 2 for income. So we'll start with first thing. First, I need to add income not credited. So it can be in any order. So I'll add income that is not credited to P&L. Then I will less income considered separately. My handwriting is very poor, so I'm sorry for that. I repeatedly tell my handwriting is one of the worst handwritings you could ever see. So income considered separately, and then you add 2 things. What do you add? You add expense disallowed, unless expense allowed. Okay. So these are the 4 additions that you need to make in all the questions that's related to PGBP. This is what you do. You start from net profit. You add income that is not credited to the P&L but still taxable. You will reduce income that is considered separately or income that is not taxable. Income considered separately or income that is not taxable. You add expense that needs to be disallowed, which should not be treated as an expenditure. So which is part of your P&L but should not be considered for income tax purposes. You less expense that are basically allowed, which means it's not in your P&L, but it's still an expenditure that needs to be considered. These are the 4 adjustments: 2 for expense, 2 for income, 2 addition, 2 reduction. So this is how you have to remember the structure of what PGBP computation. So we'll start with the first admissible deductions. So the structure goes section 30 to 37. Section 30 to 37 are allowed allowed, that is admissible. Anything which is allowed as expenditure is discussed between section 30 to 37. We'll start with 30. When you need to start a business, first and foremost thing that you require is a space, a place where you can start your business. So the first expenditure is for expenditure of building the space. That is what is important. So rent, rate, taxes, repair and insurance. So rent, rate, taxes, repairs and insurance. This is what is covered under section 30. So what if it is you're a tenant? If you're a tenant, any revenue expenditure that you have incurred is eligible. What if you're occupied and owned? Any revenue expenditure that you have incurred, automatically is also considered. The current repairs, when you say current repairs, it's revenue in nature. It's not capital in nature. And what about rates and taxes? Anything that is got to land revenue, local taxes, municipal taxes, anything related to the property, which is towards taxes, is also covered. So it need not be only India, it can also be foreign governments, rates and taxes. And finally, insurance. Insurance is a very simple thing. Insurance can be only for damage or destruction. Whatever premium is paid for insurance, that is for damage or destruction, is allowed. So these are the 4 components. First 2 is for expenditure, revenue expenditure as a tenant, as a owner. And the next 2 is rates and taxes and insurance. And in case if the rent is paid to a partner, we should make sure that the rent paid is reasonable and it's not excessive. So it cannot be something which is abnormal. And whatever expenditure is borne by the assessee alone should be taken. So if you're a tenant, as an assessee, if you have incurred something, you can take care. As an owner of the property, if you have incurred something, you can claim it for your business, In house property, there is a flat deduction of 30% of thing. So that includes all these expenditure. Now what we are talking is from the aspect of PGBP. So in PGBP, if I'm owning my own building, I'm using it for my own business, whatever is current repair can be claimed as expenditure. And if it is partly used for office, partly used for residential purposes, I need not tell you, you would have already been known. It is proportionate. So this is the first section about section 30, which is for building. Now I have a space to start my office. After having a space, what will I do? I will buy assets. I will buy laptops, I'll buy machineries, I'll buy furnitures to build up my office. So that is the next expenditure. Anything for machinery, plant and furniture is covered as the next expenditure. That is section 31. What is the eligibility? Such asset must be used for the purpose of business. So it must be used for my purpose of my own business. So that is the first thing. And repair, as we already discussed, it's only be current repair. It cannot be capital in nature. And when you say revenue expenditure, it can be renewal or renovation, but it cannot be replacement or reconstruction. Please remember the word renewal and renovation is allowed, but replacement or reconstruction is not allowed. Please remember these keywords: renewal, renovation, replacement, reconstruction. And what about insurance? I need not tell you. It is only for damage or destruction. Any insurance covered in PGBP can only be for damage or destruction. So such insurance is also covered. And when you say insurance, as I told you, premium paid in case of cash system and will include payable in case of mercantile system, which means if you are following cash system of accounting, only paid is allowed. If you are following mercantile system of accounting, payable is also allowed. So that's a very basic accounting policy. So I don't need not stress on that. So what are we talking about? Expenditure on assets. What are the conditions? It must be used for your own business, used for the own business. And what about the repairs? Current repairs can be claimed. That is something like renewal or renovation, but it cannot be replacement or reconstruction. So that is what you're calling as repairs, and insurance is also covered with respect to whatever premium that is being paid. So that is also covered. So, and these are the next section. Now I have assets, I have a building, I have an asset. Now that asset must be depreciated. So that's the next section, 32. So 30 is about building, 31 is about expenditure of plant, machinery and other thing. 32 is about depreciation of assets. So what is section 32? It is about depreciation. Depreciation, it's a very simple thing. All of you would have studied in 11th standard accounts. I need not tell you, but income tax gives you 3 conditions. Income tax gives you 3 conditions. The first condition is it must be a specified asset. So what is a specified asset? Specified asset can be tangible or intangible. What is tangible? I need not tell you. What is intangible? I need not tell you. But what I need to tell you, what is covered and what is not covered under tangible. Building and plant and machinery is covered under tangible, but books is also covered under tangible. For example, I'm a chartered accountant, practicing chartered accountant. Books annual books or publications, or all of these books are my asset. So books are an asset. It's a plant and machinery for people like me or people like most of you. Now, what is not covered in plant and machinery? Animal is not covered. Human body is not covered. So these are specifically excluded. That is, animal and human body are specifically excluded. And what is also included in tangible? The furniture. So building, plant and machinery, furniture. What is included in plant and machinery? Books. What is excluded? Animal and human body. And next is intangible. What exactly is intangible? Intangible is typically various categories of intangible. There you have no patent, copyright, trademark, anything. But the only situation is that intangible cannot be a goodwill. It's a very recent addition. It was only introduced in Finance Act 2021. So Finance Act 2021 said goodwill is no more an intangible asset. In fact, it's no more an asset. So goodwill cannot be depreciated. Goodwill cannot be depreciated. It's a recent amendment that is just 1 year old. It was only introduced in Finance Act 2021. What is applicable for you? Finance Act 2022. So when we say amendments, not only 2022, sometimes FA 2021 amendments also are critical. Amendments like what we saw, like PF or even COVID related things are all, it's critical for your amendments. So this is also another amendment which is critical. Goodwill is not considered as an asset. So if there is a goodwill in your problem, don't depreciate. It's not eligible for depreciation. So that's the first situation, first condition. What is the first condition? The asset must be specified. It can be either be tangible or intangible. What is the second condition? Second condition, it must be used. It must be used for the purpose. So first must be a specified asset. Now we say such asset must be used for the purpose of business. When you say used, should I use it for my own purposes? Yes. But if my business is in the business of leasing or hiring, what will I do? I'll buy 100 cars. I will give it on rental. So now who's using the car? Not me, someone else. But it's still my business. It's still my business. What is my business? Leasing or hiring. So in case of leasing or hiring, it is eligible. And what about passive or ready for use? When you say passive or ready for use, I'll tell you a very short example. I buy one machinery today in October. I buy one more machinery in February. But what is the use of the second machinery that I purchased in February? It is to use when the first machinery is repaired. Its first machinery is repaired. It's not working. When the first machinery is not in working condition, I will use the second machinery, which means the second machinery is always ready. It is always ready. It is just passively used. It is being passively used. So that's why I'm saying that it is basically covered under here, passive, ready for use. So these are the things that are means by use. So lease, hire, or passive and ready for use also covered. So, and what about the third situation? What about the third situation? It is owned wholly or partly by the assessee. Owned wholly or partly by the assessee. So which means assessee must be the owner of the asset. Assessee must be the owner of the asset. He could be entirely owning or jointly owning, but he must be the owner of the asset. So these are the three conditions: specified asset, used for the purpose of business, owned by the assessee, owned wholly or partly by the assessee. These three situations. Now, what will be the method? We would have studied methods of depreciation in school or college. What is the method of depreciation? Basically commonly used is straight line method and WDV method. Income tax prescribes WDV method. Income tax prescribes WDV method, but only for power generation units. Company in power generation can adopt straight line method or opt WDV in the first year of operation. So the moment they have commenced operation, they have to decide whether they are going to adopt straight line method or they are going to adopt WDV method. So that's an option given in the first year alone. Subsequently, they have to uniformly follow whatever they have already chosen. But if it is not power generation unit, everyone else is only eligible for WDV. There is no option. And when you talk about depreciation, usually depreciation is what? Based on the number of days, like in your Companies Act or accounting, whatever you would have studied, would be based on number of days. But income tax, it is based on number of days, but there are only two concepts. It is either full or a half depreciation. Full or half depreciation. The cutoff date is 180 days. So if an asset is used less than 180 days in a particular year, you have to only give 50% depreciation. So 50% depreciation alone can be provided for assets used less than 180 days. Now there is something also called additional depreciation. Something else is also called as additional depreciation. Apart from this regular depreciation, which we discussed now, there could also be additional depreciation. It is only eligible for manufacturing units. When you say manufacturing units, it also includes printing and publishing of newspapers and other things, and power generation unit. These three businesses, manufacturing, printing, publishing, and power generation unit, are eligible for additional depreciation. What is the additional depreciation? It is eligible for new plant and machinery. So it's a new plant and machinery which is not purchased for office premises. So any asset, any plant and machinery for office is not allowed. It must be for factory. And any electronic appliances is also not allowed. Air conditioner, refrigerator, all that is also not covered. So any appliance is also not covered. Anything purchased for a residential accommodation, guest house or something, is also not covered. Any road transport vehicles, RTV, road transport vehicle, is also not covered. Apart from these assets, there is also one more category which is called 100% deduction. Assets which are eligible for 100% deduction. Scientific research, specified business, we'll see that. So these assets are also not covered. So it must be a new plant and machinery. It cannot be office premises, appliances, residential accommodation, guest house, road transport vehicle, 100% deduction. If it is not one of these, then that plant and machinery is eligible for additional depreciation. What is additional depreciation? It is eligible as 20%. 20% apart from your depreciation. Apart from depreciation under section 32, there is an extra depreciation of plus 20%. Now this 20%, in case if it is for an asset that is being used for less than 182 days, you claim 10% in year 1, 10% in year 2. Please remember, you claim 10% in year 1, 10% in year 2. So if your question says a new plant and machinery was purchased by the assessee in December 2021, please remember it was used less than 180 days in financial year 21-22, which means in financial year 22-23, you can claim balance additional depreciation. So the additional 10% can be claimed in financial year 22-23. That's why we say 10% will be claimed for 2 years. The asset is used less than 180 days. Clear with this concept? So that is section 32. We'll understand some of the depreciation rates of key depreciation rates. I'm not going to give you the entire thing. These are very critical. So for example, if it's building, residential is 5%, non-residential is 10%. Anything related to water related, the building structures, it is 40%. Furniture and fittings, including electrical fittings, is 10%. Plant and machineries, you have so many categories, motor car, which is not on hire, which is on hire. And then you have airplanes and other things. Computers, including software, is 40%. So this is common. Books is also, I'll also include books here. So computer, books, all of this are covered under 40%. And any general plant and machinery will be 15%. Any intangible is 25%. These are commonly tested assets. Another commonly tested, which I have missed out here, is books. So that's why I've given it. Books is also 40%. Now, these are the commonly tested assets. Now, so we have covered section 30, 31, 32. 32, we said it's about depreciation. But when you say depreciation is calculated on cost or WDV. If it's a new asset, it is calculated on cost. If it is an existing asset, it is calculated on WDV. Correct? Now, what is the cost? Generally, cost is nothing but the cost that I am incurring. If I'm buying a particular plant and machinery, whatever I have paid for the plant and machinery is covered. In case, if certain things are met by others, which means government is giving subsidy. Government is giving subsidy for my plant and machinery, which means that subsidy means that expenditure is not mine. It is going to be replaced. So automatically, whatever is met by others needs to be reduced. And similarly, anything covered under section 40A clause 3. What is it? Cash disallowance. So what is 40A3? Cash disallowance, which means any expenditure which is more than 10,000, is not an eligible expenditure. So if you're buying an asset and you're giving in cash for more than 10,000, for such amount, you should not consider as cost. So cost is actual cost minus met by others minus disallowance under section 40A clause 3. So this is your cost. But in some cases, cost will be different. For example, if it is a gift or inheritance or building previously owned by someone, you take the previous owner's cost. You provide depreciation till date. Previous owner purchased it in 2018. He has gifted me in 2022. 2018 to 2022, I will provide depreciation and calculate the WDV. That will be considered as my cost. Even though I have got it as gift or inheritance, still I have to treat a cost in my books of account. What if inventory is converted into capital asset? The fair market value on the date of conversion will become the cost. What about the interest cost? I have borrowed it on loan. Asset is purchased via loan. Whatever interest is incurred till the asset is first put to use, similar to your accounting standard, till the asset is first put to use, whatever is interest cost needs to be capitalized. In case, of course, there is a subsidy or something, whatever is claimed as subsidy should be reduced. For example, if you are claiming GST refund, GST credit, your actual cost minus GST credit, the ITC, actual cost minus ITC will only be your actual cost. So actual cost is basically actual cost minus met by others minus cash disallowance under section 48 clause 3. You should also reduce what is claimed as credit. So this is about actual cost. What about subsequent assets? WDV is where you have to calculate depreciation. So what is WDV? Of course, in the first year, WDV and actual cost will be same. In the subsequent year, actual cost minus depreciation till date will be treated as a WDV. When should you make the WDV as nil? In one situation, you have to make WDV as nil when money's receivable is greater than WDV of all assets. Basically, when you say WDV, opening WDV plus addition minus deletion. So this is your closing WDV. So you charge depreciation on this. You charge depreciation on closing WDV. You charge depreciation on closing WDV. If this is not visible, I'll write it here. Closing WDV. So closing WDV is what you will charge depreciation. So opening plus addition minus deletion will give you closing WDV. You will charge depreciation on closing WDV. But when your deletion amount is greater than the opening and addition, then there is no depreciation. Whatever is the negative will be treated as your profit. So opening WDV will be treated as nil. When your closing WDV is negative, it will be treated as nil. So when does that happen? When money's receivable is greater than WDV or all the assets in block are transferred. So when the WDV is negative or when there are no assets in the block, in these two situations, your WDV will be treated as nil. And when depreciation, there is something called unabsorbed depreciation. It's typically when carry forward. Unabsorbed depreciation is something, there is a depreciation already in the books of account. I will disallow that and provide income tax depreciation. I will disallow the depreciation in the books of account and provide what is eligible as per the Income Tax Act. When I'm providing that, if there is no sufficient profit, which means the balance depreciation which could not be adjusted with the profit will be called unabsorbed depreciation, and there is no limit. It can be carried forward indefinitely. And irrespective of whether you have business or not, it can still be carried forward. So unabsorbed depreciation, remember 2 points. There is no limit for carrying it forward. And second thing is, it can be carried forward even if the business is not in existence. So when you're adjusting depreciation, you will first adjust current year depreciation and you will adjust brought forward business losses and only then come to unabsorbed depreciation. So that is about your depreciation. So we'll move on to the next important section, that is section 35. As I told you, I'll only take through sections that are important, that is section 35. So section 35, we are going to split it into 3 segments. What is section 35 first? Section 35 is about expenditure on scientific research, deduction on scientific research expenditure. So what type of expenditure are we talking about? First category is for my own business. Second category is giving to a third party. Second category. Third category, my own business only, but for a separate R&D unit. So first is for my own business. Second is for third party. Third is for my own business, but separate R&D unit. So these are the 3 situations. When I'm incurring it for my own business, which means the company itself is into scientific research only. Their entire business objective is scientific research. So if for that such companies, if there is any expenditure, both revenue expenditure and capital expenditure will be considered. Both revenue expenditure and capital expenditure will be covered as deductions. And provided capital expenditure, land alone is not allowed. Land alone is not allowed. So basically, when you say incurred for own business, both revenue and capital is allowed. In capital, land alone is not allowed. Please stress the word land alone. Land alone is not allowed. So I'll tell you why. In next few seconds, I'll tell you why. Paid to a company, that is, I'm paying to a third company, that is another company which is into the business of scientific research development, SRD as the main object, or I'm giving to a university, national laboratory, IIT, or any other institution which are doing scientific research or statistical research. So if they're into some form of research, science or statistics, then whatever is paid to the company, institution, or association is basically claimed as expenditure. It's straight away allowed. Whatever you're paying is allowed. The third category is in-house research and development. Here it is land and building. What did we say here? For own business, land alone. But now what are we saying? We are saying land and building. So when it's in-house, in case of in-house research and development, both the expenditures, that is land and building is not allowed. But what are the conditions here? In-house R&D, they should be in the business of biotechnology or in the business of manufacturing any article other than the articles in 11th schedule. What is 11th schedule? 11th schedule is basically an article which is not good for the society or environment. Alcohol, tobacco, etc. are all covered under 11th schedule. So for such assets, you can manufacture anything other than those things. So such assets are basically covered here. So that is what you're calling it as eligible businesses, business of biotechnology and manufacturing other than article specified under 11th schedule. So for them, all the expenditure can be claimed as deduction other than land and building. So both are not allowed in this situation. Now I have already claimed scientific research, but subsequently I'm selling it. What happens? So it will be treated as deemed income under section 41. So section 41 is about deemed income. We'll discuss that separately. But as of now, we'll discuss this one provision alone. So I'm selling that asset on which I've claimed scientific research without using for specific purposes. So without using for other purposes. So what are they saying? Sale proceeds plus amount of deduction minus capital expenditure or amount of deduction, whichever is lower. Practically in most of the cases, this part and this part, that is amount of deduction and capital expenditure, will be same. Why? If capital expenditure is 200, deduction under section 35 is also 200 only. So which means these two will be same, amount of deduction and capital expenditure. So this formula in turn is like sale proceeds or amount of deduction, whichever is lower. So that will be treated as deemed income. If your sale proceeds is 100 and amount of deduction is 200, 100 or 200, whichever is lower. So 100 will be treated as deemed income. So sale proceeds or amount of deduction, whichever is lower. So this is how you can remember it. You can always ignore this amount plus amount of deduction minus capital expenditure can be allowed. Why? Because whatever is the capital expenditure, you would have claimed as deduction, amount of deduction. So in most of the situation, it will be sale proceeds or amount of deduction under section 35, whichever is lower. Moving on, the next admissible deduction we'll be seeing is section 35AD. 35AD is for specified businesses. So when I say specified businesses, I have summarized all the businesses in this one slide. I'm not going to take you through in each of these businesses, starting from cold chain to infrastructure facility. There are several businesses, mainly warehouse. This is a commonly tested warehouse of agriculture, produce, or sugar is a commonly tested, and a hotel is tested, a hospital is tested. What is the condition for hotel? Minimum 2 stars. What is the condition for hospital? Minimum 100 beds. Fertilizer production, transport hub, beekeeping, fabrication, and finally infrastructure facility. So the commonly tested businesses, this is tested, this is tested, this is tested, and then this is tested. So these are the commonly tested businesses in your 35AD. But anyways, you can remember overall, you can remember whatever they are into. So this is what it is about. Now, what is a provision? What is a provision? Provision says you can claim 100% of capital expenditure, which means in both section 35 and 35 AD, you are eligible for 100% deduction of capital expenditure, not revenue expenditure. It is eligible for capital expenditure, which means what? You cannot claim depreciation. Since you are claiming 100% here, there is no depreciation on such assets. So 100%, it's like 100% depreciation. So 100% of capital expenditure will be allowed. What are the assets on which I cannot claim? In scientific research, own business, land alone is not covered. In-house research and development, land and building is not allowed. Now, in specified business under section 35 AD, land, goodwill, financial instrument, all these three are not allowed, all these three are not allowed. If it's a detailed class, I'll probably explain you why and tell you how to remember. But of course, we are running towards a race of completing our 42-mile stretch of marathon. So we are already halfway through. So we are supposed to rush through. So I'm not going to explain you why and all. So please remember, for scientific research, in own business, land alone. Scientific research and development, land and building. Specified business, land, goodwill, financial instrument. These three are not allowed. So this is what you have to remember. And what if the expenditure was incurred before commencement of business? What if the expenditure was incurred before commencement of business? The deduction in the year of commencement for prior period investment and capitalized. So if it is capitalized on the date of start, if the business is starting today, 17th October 2023, whatever was incurred earlier, if it is capitalized on the book on 17th October 2023, it can be claimed. Otherwise, it cannot be claimed. And when I speak about this before prior period expense, I will also talk about a little bit about scientific research also. In scientific research also, previous year expenditure can be allowed. Previous year's expenditure, that is preliminary expenses, can be allowed. Condition is maximum of back date, 3 years, last 3 years expenditure before commencement. 3 years before commencement can be allowed. Only two types of expenditure: salary and raw material. Only these two expenses can be allowed as preliminary expenses. So whatever was incurred 3 years before in own business, incurring for own business, whatever was incurred 3 years before, salary and raw material, can be claimed as scientific research deduction in the year of commencement, provided the quantum is approved by the authority. So if my salary and raw material is 80, what is approved is only 60, I can only claim 60. So that is what I'm saying, whatever is approved. And coming back to 35 AD, we were talking about what asset is not allowed and what about the prior period expenses, that is before commencement. Apart from this, there is one more thing that we need to remember. 40A3 applies. 40A clause 3. What did we say? Cash disallowance. So if any asset is being purchased with cash by spending more than 10,000, such value cannot be allowed as deduction. So that provision is applicable for claiming 35 AD deduction also. Clear? So now we have covered all these major deductions. We'll go to the last two sets of deductions, section 36 and section 37. Section 36 and section 37. What is section 36? It is like a general deduction. We'll call it as general deduction. Okay. 37 is miscellaneous. Whatever is not covered till 36 will get covered under section 37. So we'll start with 36. First and foremost that we'll be discussing about 36 is about insurance premium. When I say insurance premium, you yourself tell me, I have already repeated this word a couple of times. What should be the purpose of insurance? It should be for the purpose of damage or destruction. So we already saw it for building. We already saw it for plant, machinery, furniture, and other thing assets. Now we are also seeing it for stock. So whatever is being paid for damage or destruction is basically can be allowed. And when you talk about health of employees, health is nothing but damage or destruction of employees' lifestyle. Yeah. So that is also kind of damage or destruction only. So premium paid for health of employees, that is damage and destruction of employees. So that is also covered. That is also covered here. And one thing that you have to keep in mind is cash payment, cash premium payment is not allowed. Is not allowed in case of medical premium. Medical premium. So health of employee cannot be allowed if it is in cash. So that is insurance. Moving on, the next thing that we'll understand is PF and other funds. We are going to split this into two components. Employer contribution, employee contribution, employer, employee. What is the difference? Employer contribution typically says whatever is contribution should be paid, Moment it is paid, it is considered. So contribution is allowed on the moment it is actually paid. So it is for the benefit of employee only. So whatever is paid will be considered. But what about the employee contribution? Employee contribution says it will be allowed. It will be allowed only when paid within the due date of the relevant fund. So the keyword is due date of relevant fund. Due date of relevant fund. What do you mean by due date of relevant fund? For example, PF due date is 15th of subsequent month. 15th of subsequent month. For September, it is 15th October. So if someone is paying today, that is 17th October, there is a delay of 2 days. This expenditure of employees' contribution to Provident Fund will not be allowed as an expenditure in the hands of assessee, in the hands of taxpayer. So that is the difference between employer and employee. Please remember, it is very critical. Employee contribution needs to be paid within the due date specified in the relevant fund, not any other time. So employer contribution, it only says it needs to be paid. What is the cutoff date? We'll see subsequently. Basically, it must be paid. It can even be paid late. So that's what we are trying to say. Okay, so that is basic insurance and PF of section 36. Next thing we'll understand about section 36 is bad debts. That is discussed in 36 subsection 1 clause 7. What is bad debts? We all know that amount which cannot be recovered. It's a sale made to a debtor which cannot be subsequently collected. So it's a bad debt. It was a debtor. Now it has become a bad debt. So now this is recovered. This is written off. This is written off my books. One thing that you have to keep in mind is this bad debt should belong to a debtor who has contributed income this year or earlier. So he is my debtor. So bad debt should be there. So don't get confused with these wordings and other things. The only point is bad debt should be from revenue. Because of a debtor, who has given you a revenue. That revenue could have happened in the current year or some earlier year. So that is what they are trying to say. And in case if it is a loan, if you are in the business of providing loan is also considered as bad debt. Otherwise, loan, the temporary loan or any short-term loan is not covered. When it is covered, when the business itself is in the business of money lending. And one important condition is there is no requirement to establish that you have not able to collect. In unrealized rent and house property, we said that steps should have been taken. And we had conditions, legal proceedings should have been taken, steps should have been taken to vacate the property. All this is a condition. But here, what are we saying for bad debt? Nothing. We are only saying, if you say it is a bad debt, I agree. That's all. I will not go beyond that. So that's what we are covering here. And what if subsequently in bad debt, you're receiving short or receiving more than that? So for example, if my debtor is 10, I am considering 6 as bad debt, 6 as receivable, 4 as bad debt. Let's say this is in 21-22. In 21-22, this 4 rupees would have been treated as bad debt. Subsequently in 22-23, let's say I am receiving 7. I was supposed to receive how much? 6. But I have received 7, which means the extra one will be treated as my income. Ultimate recovery is more than the bad debt. So in that case, it will be treated as my business income under section 41. In case if it is short, for example, instead of 6, I'm only receiving, let's say 2. So the balance 4 will be treated as fresh bad debt, excess bad debt. So the shortfall is also bad debt. The excess recovered is an income, deemed income. So this is what is about bad debt, section 36, 1 clause 7. The next is anything else that is covered in section 36. Bonus is covered, which means any bonus paid to an employee is covered. Any interest payment is covered. Only thing is when it say interest is on capital asset, till the date it is put to use, it must be what? It must be capitalized. Anything above, it will be revenue interest. Discount on zero coupon bonds. So discount on zero coupon bonds, pension scheme, securities and commodities transaction tax, all these are eligible. And with respect to family planning, only for companies, a company allowing family planning for its employees, whatever expenditure on promoting family planning, he'll be claiming it for a period of 5 years, 20% of 5 years. Whatever could not be absorbed in that year will be carried forward as unabsorbed, like unabsorbed depreciation. So like unabsorbed depreciation, there is also unabsorbed scientific research and unabsorbed family planning. So these three is n number of years, unlimited. You can keep carrying it forward for any number of years. So these three are common treatment perspective. So that is section 36. So the next section, the last section in admissible deduction. The last section in admissible deduction is section 37. It is called as a general deduction. As I told you, it's a miscellaneous deduction. So what is the condition? Very simple. You yourself can remember. First, what is the major condition? Since it's a miscellaneous, which means it should not have been already covered between section 30 to 36. So that's the first condition. The first condition says it must not have been considered in section 30 to 36. Second, what are we saying? It must not be in capital in nature. It cannot be capital in nature. Of course, what is allowed? Only revenue in nature will be allowed. And it should not be personal in nature. So that's also a common thing. It must be wholly and exclusively incurred for the business. Business carried by the assessee. It is already commenced and it is incurred by the assessee. So it is carried on by the assessee. It is for a business which is already commenced and it is actually incurred for the purpose of wholly and exclusively for the purpose of assessee's business. And fifth thing, such expenditure should be happening in the accounting year. So if your examination is in previous year 22-23, so this expenditure should be incurred in previous year 22-23. Last one, it should not be an offense or prohibited under law. Finance Act 2021 introduced an amendment. It said, when you say not an offense or prohibited under law, they explained what is offense or what is prohibition. Basically, when you say offense or prohibition, under the Indian laws or global law. Some of the examples given in your study material, we'll go through basically about section 37. Anything advertisement in souvenirs of political party. Souvenirs is like when tsunami came or anything came, whatever relief was given, chief minister's photo will be stuck, a hero's photo will be stuck, celebrity's photo will be stuck in that relief material. So that is basically giving relief. Now, what if it is given to a political party? Whatever the political party is distributing, you stick your company sticker on that. So such things are called souvenirs. Most of you would be aware what souvenirs is. So any souvenir given by the political party, you're advertising in that, it is not eligible. CSR expenditure is not eligible. Freebies to medical practitioner, it is against law, it is an offense, so it is not allowed. Premium on key man insurance policy is allowed for business purposes. Though it is specifically for some individual, it is still allowed as business expenditure. Expenditure incurred on abandoned feature films. Like directors, like very famous director, take movies for 2 years, 3 years, but it never gets released. So it's called abandoned feature film. So expenditure incurred on abandoned feature film is a revenue expenditure. Apart from that, they've also given certain other clarifications. Any occasion which is not religious in nature, which means it is, when you say religious in nature, it is for the company as a whole. You are spending some function for the company as a whole, for the organization as a whole, that is allowed. It should not be for a specific set of people considering the religion. It should be common for all the employees. So that expenditure is allowed. And any professional tax paid is allowed. We saw in salary, professional tax borne by the employer should be included in the salary and then claimed as deduction. So any professional tax payment is allowed. Expenses importing on training is allowed. Fees paid to ROC for enhancement of capital. Not being, so whatever is being paid to ROC is allowed, but it should not be for enhancement of capital. What is enhancement of capital? Increasing the authorized share capital. So increasing the authorized share capital is capital expenditure. It's not a preliminary, it's not a general deduction. Annual listing fee paid to stock exchange. Expenditure on advertisement and souvenirs other than political parties. So it is other than political parties. For everyone else, it is allowed. Interest payable on unpaid purchase. We already saw what is unpaid purchase in house property. So any interest paid toward that is allowed. Any profit sharing scheme, payment towards profit sharing scheme, any rebate issued by the consumer cooperative society is also covered. So all these are called general deductions under section 37, which denotes what is covered, what is generally eligible or not eligible. So, so that is about section 37. With that, we have covered all the admissible deductions. So when you say admissible deductions, I said section 30 to 37. Now, section 40, 40A, 43B, okay, 43B. These are called disallowance. Okay. 40 says this expenditure is not allowed. 40 says this expenditure is not allowed. 40A says I am okay with this expenditure. I am okay with this expenditure, but I am not okay with the way you have made that expenditure. I am okay with the expenditure, but not okay with the mode or person. Not okay with the mode or person is 48 disallowances. 43B. 43B, I am okay with the expenditure, but I will allow it only on payment. So these are the differences. 40 is straight disallowance. This expenditure is not allowed. 40A, this expenditure is allowed, but I will not allow because of the mode in which you have made the payment, or the manner in which you have made the payment, or the person in which you have made the payment. 43B, I'm okay with the expenditure, but I'm not okay because you have still not paid it. So that is 43B. So these are the three sections that we are going to discuss it right now. So what is section 40? We'll start with the first concept of tedious disallowance under section 40. So that is covered under 40 clause A, 40 clause A. So there is a section 40A. This is section 40 clause A, 40 clause A. So it's basically for tedious. So when you have not deducted, what is tedious? Tax deducted at source. So it is for specific transactions like salary, contract, professional fees. You should have deducted tedious. So if someone is paying me auditor fees, they should deduct me tedious and pay. So if they have not deducted, of course, that expenditure is not allowed for them. Not deducted or not paid on or before the due date of filing return. So what is the due date? Due date of filing return. Original due date of tedious is 7th of subsequent month. So for September, it is October 7th. For October, it is 7th November. So that is how the due date is. But what here it says is not deducted or not paid on or before the due date of filing return of income. And what are the expense covered? One is for non-resident payments and 1A is for resident payment. So one says any interest, royalty, fees for technicals or any other sums when you are supposed to pay outside India, when you are supposed to pay outside India or in India to a non-resident or a foreign company. So this is what it is covered. Whereas 40A, 1A is only for resident, only for residents. And what is a disallowance? 100% of such expenditure. So if your expenditure is 5 lakhs, 5 lakhs is disallowed. If your expenditure is 20 lakhs, 20 lakhs is disallowed. But only thing is, the good thing about this particular provision is, it is disallowed now, but in the next year, if you have deducted tedious, I can claim this expenditure. So in the next year, if I've claimed a deduction, if I've claimed a tedious deduction and I've remitted it, I can claim the entire amount. So even though it is disallowed in 1 year, there is a possibility that will be allowed in the subsequent year, So it will be allowed in the year when tedious is subsequently paid. This is for non-resident. That is 100% is for non-resident. What about domestic? It is 30%. So any payment to a resident, 30% of such expenditure. Here also it is allowed when subsequently paid. So it's a very simple policy. TDS for non-resident. If TDS is not deducted or deducted and not paid, the entire expenditure will be disallowed. But if it is towards a resident for any expense, then 30% of such expenditure will be disallowed. So this is the comparison between non-resident tedious non-compliance and resident non-compliance. So these two is what we are going to discuss it. We have discussed it right now. So that is section 40 clause A. Okay. Apart from this, there are other provisions on section 40 clause A itself. So again, we are still in clause A. So any taxes, that is any taxes, it could be income tax, it could be whatever taxes, including surcharge, cess, interest, everything, including surcharge, cess, interest, This one bold is basically an amendment. Surcharge and cess is an amendment. So including surcharge and cess or interest on tax is basically disallowed. What is disallowed? The entire tax will be disallowed. Any amount that is technical services, which is basically for a state government, which is appropriated directly or indirectly from a state government. So the whole charge will be disallowed. And salaries payable outside India to a non-resident on which tax has not been deducted. So this is also about TDS. The entire salary will be disallowed. And effective arrangements for tax deductions on payment made from provident for other funds to employee. So when employee is being paid from provident fund or something, do you have a suitable system where TDS will be taken care of? If that is not there, then it is disallowed. Not much question. This is not much question in your examination. Tax on non-monetary perquisite is the tax will be disallowed. So if you're giving a motor car or any rent-free accommodation, that is called non-monetary perquisite. Any TDS deducted on that is basically not allowed for the purpose of income tax purposes. So this is about your other things under section 40 clause A. 40 clause A. We will move on to the next thing called 40 clause B. 40 clause B. So what is this? It is about partnership remuneration. What is allowed in the hands of partners is what we are going to discuss it right now. We're going to discuss it under two different segments. First segment is interest paid to any partner. Second segment is remuneration paid to a working partner. So when you say partner, as we discussed, it must be allowed only for working partner. It is not allowed for anyone else. And no expenditure on interest or remuneration is allowed where the payment is not authorized or in accordance with partnership deed. So if you need to take interest or if you need to take any remuneration, such amount should be specified in the partnership deed. Partnership deed should say that this much of rate of interest will be given for capital. This much of remuneration should be given. So this is what should be discussed in the partnership deed. It must be discussed in the partnership deed. Include interest of partners in representative capacity. I'll leave this point, not much of importance. However, with respect of interest and remuneration by in accordance with the partnership deed shall be allowed as follows. But now we said it is allowed, right? We said it is allowed for working partners. We need to know the limit. As far as interest is concerned, maximum of 12%. Maximum of 12% per annum is what is allowed. But in the case of remuneration paid to working partner, it's like a slab rate. It's like an individual slab rate. For the first 3 lakh of book profit, it is 1.5 lakhs or 90%, whichever is more. 1.5 lakhs or 90%, whichever is more. But on the other hand, for the balance book profit, that is anything above 3 lakhs, maximum of 60%. The reason here we are having a slab limit like this is, even if you are making a loss, in that year, you are still eligible for 1.5 lakhs. You're still eligible for 1.5 lakhs. So for the first 3 lakh, it is 1.5 lakhs or 90%. For the balance book profit, it is 60%. Clear? The next section, now we are moving to section 40A. So far we saw 40 clause A, clause B. Now we are going to say 40A. What is 40A? I told you very simply, expenditure is okay, but I'm not okay with the mode or the manner in which you are making the payment. So that is what the expenditure is okay, but I'm not okay with the mode or the manner of the expenditure. What is it? 40A clause 2 talks about related party. Related party. So who's a related party? One who owns, if you are an individual, a relative of the individual is a related party. If the individual owns substantial interest, if the individual owns substantial interest in any other business, then that business is also substantial. It becomes a related party. Not just the individual. If this individual is owning along with the relative, individual is owning along with the interest in this particular person's business. For example, if the individual is owning 16%, the relative is owning 10%, together they own 26%. So that is also considered as related party. So related party for individual is this much. There are a lot of other related party definitions under 40A2, which is basically mostly for final, because it is about companies, partners, and other thing. What will be tested here is only on individuals. So as far as individual is concerned, there is only a couple of related party On one side, it is relative being of the individual. On the other hand, individual and the relative is having substantial interest in one another business, having substantial interest on a combined basis. Then in that case, it is automatically covered under any person carrying on business or profession. Okay, we already discussed about substantial interest. What is relative? Spouse, brother, sister, or any lineal ascendant, descendant. So of course, first three I need not explain you: spouse, brother, sister. Lineal ascendant is my father, grandfather, great grandfather, son, grandson, great grandson. So that is lineal ascendant, lineal descendant. So lineal ascendant is upwards, father, grandfather, descendant is son, grandson, etc. So this is what you're actually calling it as relative definition. 40A3 and 40A3A. So 40A3 and 3 are more the same thing only. The only thing is rupees 10,000, any payment to a person in a day, no deduction shall be allowed. If rupees amount in excess of that is up to 10,000 is okay. Above 10,000 is made to a person in a day, to a person in a day. So which means if I'm giving it to 3 people, 8,000, 8,000, 8,000, it is allowed. If I'm giving to the same person 8,000 today, 8,000 tomorrow, 8,000 the day after, that is also allowed. So the only thing is, generally this type of payment should be properly made by account pay check, DD, bank, electronic system, or any other item in the prescribed modes. So if these are the models in which the amount is being paid, it is allowed. Otherwise, what happens? Any expenditure above 10,000, any expenditure exceeding 10,000 will not be allowed. So if you have spent 12,000, 10,000 is not allowed. 2,000 can be claimed as an expenditure. And 40A3, I leave it. So 40A3 relates to previous year. If it's current year, it is 40A3. If it is previous year, it is 40A3A. And then you have second proviso. Basically, if you're in the business of plying, hiring, or leasing goods or vehicle, and payments are allowed under section 40A3 and 3A, then automatically the limit is 35,000. So what are they saying? The business is in the business of plying, hiring, and leasing goods. And in that case, the limit is not 10,000. The limit is 35,000. The limit is not 10,000. The limit is 35,000. Now, we discussed two things. We said should not be paid in cash, should be paid through proper banking mode. What is the limit? 10,000. About 10,000 to a person in a day is not allowed. And in case if it is in the business of logistics and other things, then it is 35,000. Instead of 10,000, it is 35,000. But of course, you have to collect the PAN and confirmation from the respective vendor. Now, apart from these things, there are some relaxation. There are some relaxation to this rule. So that is discussed in Rule 6TD. So for our classroom purposes, we are going to split this into specific heads. Study material will not have heads. For the purpose of class, we are splitting it. Payment to small industries. Payment to small industries. So whom do they call small industries? One who's in the business of agriculture, forest produce, fish, horticulture, etc. If they are into that business, whatever is being paid to them is considered a small industry, and which means it is not deductible. It is still deductible only. And next, payment is made for the purchase of the products manufactured or processed without the aid of power in cottage industry. Most of them will be operating in handloom area. So such things are basically handloom based things. So any payment made to them, who are working without the aid of power, this will be called as, there is no limit. To these people, you can pay how much ever you want. To these people, you can pay how much ever you want. There is no limit. They only say that first, if it is paid to them, it is allowed. There is no limit of 10,000 or 35,000. No limit of 10,000 or 35,000. So that's what we are seeing. Okay. Next thing is bank unavailability. I need to make a payment on a particular date. On that date, bank is not available. It is okay. But in otherwise, I need to make a payment on a particular date in which on a particular date, there was no bank in that village or in that location. I am supposed to pay to some person, Mr. X. X lives in a remote village. That remote village does not have any banks. So which means automatically what should I do? I should only give, I should only transfer it through banking mode. So that is what we call bank unavailability. So when bank is not available on that day because of strike or something, or there is no bank in that location, then it is called bank unavailability. Next, what are we saying? Salary payments. So I'm making salary payments to an employee who's working outside the office space, outside the office premises. If the office is in Chennai, let's say he's working in Bangalore, like marketing employee has gone there to do some work or something. So that amount can be up to for 15 days. So if he's working for more than 15 days in a particular location and salary is being paid for that particular timeline, then it is okay. So continuous period of 15 days or more is the basic timeline. If that is satisfied, that payment is covered. In case if there is employee is passed away, whatever is settlement being paid up to 50,000, that is not exceeding 50,000, will be treated as okay. So it is not there is no issue. So if it is paid above 50,000, it is not allowed. So this is what we have to keep it in mind. And other than this, payment to any government or banks is also covered. Payment made from principal to agent is also covered. What is principal and agent? Distributor, dealer, or something like that. Principal and agent is also covered. Authorized dealer or money changer against purchase of foreign currency. So you can purchase foreign currency. There also there is no limit. And when I say banking mode, it could also be paid through letter of credit, telegraphic transfer, bill of entry, and book adjustments. Call as 48.3. In simple, what should you remember? Any payment exceeding 30,000 in the current year or accounted in the earlier year, paid now. Current year payment or accounted in the earlier year, paid now. So both these are covered. With respect to this 48.3. And the limit is generally 10,000. But if it is logistics business, it becomes 35,000. If it is for the purpose of retirement benefit, terminal benefit, it becomes 50,000. So this is what you have to do. If it crosses this limit, the entire amount is taxable. If it crosses 10,000, not the difference is taxable, the entire amount becomes taxable. So that is about your not deductible under 48.3 and 3A. Okay, the next is gratuity. I will not take through this. Gratuity alone I'll take through. Any provision for gratuity, is basically disallowed, and anything which is paid, actually paid or payable is typically allowed. So that is what it is about. So section 48.7. Any provision is not allowed. Any payment is allowed. Any provision is not allowed. Any payment is not allowed. So next section that we'll see is section 43B. It says whatever system of accounting you follow, certain expenditure will be allowed only on payment basis. So what are the thing? Tax, duty, cess, all of these are allowed only on payment basis. Employer contribution to provident fund. Please remember, it is the employer contribution. When should the employee contribution be made? Within the due date specified in the relevant act. But what about employer contribution? It can be paid till due date of filing. So whatever is paid till due date of filing will automatically be allowed as an expenditure. So bonus or commission, again, paid till filing the return of income, due date of filing return of income. Interest on any loan. So when any public financial institution or state financial or industrial corporation has issued loan, any public financial institution, state financial institution, industrial corporation, if they have borrowed loan and any interest is basically not paid, or any deposit taken from NBFC or systematically not a non-deposit taking NBFC. So NBFC is non-banking finance company. So if they are giving any loan to which you are not able to pay interest, that is also not covered. A scheduled bank, apart from these banks, if you are a scheduled bank or a cooperative society, for this also interest must be actually paid, but it is still not applicable for agriculture credit society and agriculture cooperative, agriculture and rural development bank. So for these couple of banks, schedule could be interest schedule, whatever is supposed to be paid could be in whatever model you have. That is, interest on any loan should be paid, only then it can be claimed. Payable cannot be claimed. So there is a schedule that I'm paying these days. If you have paid, it is allowed. If you have not paid, it is not allowed. And when you say paid, one thing that you have to keep in mind is conversion of loan is not allowed. So for example, during COVID time, I'm not able to pay my EMIs. So I was supposed to pay interest every month. The last 1 year, the interest accumulated is around 25 lakhs. Interest alone is 25 lakhs. Now the bank says, I'm giving you an opportunity. I will convert this 25 lakhs. I will convert this 25 lakhs into a loan or something. Now, this conversion, that is the interest alone, interest of 25 lakhs is converted into a loan. This conversion is not payment, but subsequently, when that interest is paid, it will be considered as revenue expenditure. So one good example is about the COVID period interest that got converted into a loan. So that is what we are talking about. Earned leave is leave encashment. So whatever is unutilized leave you get, there is a calculation method for that. We already saw that. So earned leave is also allowed only on payment basis. From the salary perspective, we already saw the working, how to calculate the exemption to leave encashment. But as far as your this PGPP is concerned, any unpaid interest, any earned leave will also be allowed only on payment basis. And last one, you will not be tested on your examination. Paid to Indian Railways for the use of railway assets. So this is what is section 43B is about. So the next section that we'll be talking about is deemed income. We already saw two sections, 3 and 4. 3 was for scientific research, 4 was for bad debts. So we already saw section 3 and 4. So 3 is bad debt, 4 is deemed income for scientific research. So we already, 3 is scientific research, 4 is bad debt. So these two we already seen. What is the other one that we are going to see now is remission or cessation of liability, which is nothing but very simple. A particular creditor is there. I owe that creditor 50,000 rupees. I owe that creditor 50,000 rupees. Now that creditor says, hereafter you need not pay me. Hereafter you need not pay me. Now automatically that 50,000, which is currently sitting as creditor, now I have to write off. When I write off, what do? I have to credit something in P&L. So it's an income. So this income is what we are talking about. And that income will be taxable even if the business existence is not there. In case the business is subsequently succeeded, which means it is succeeded by son has taken over the business of father. Though the owner has changed, it will still be taxable in the hands of successor. It will be taxable in the hands of successor. So that's what it is about. And these losses are something, when you are treating these deemed income, you can adjust losses. Even though when the business is no longer in existence. So that's what they're talking about. For all these things, you can adjust business losses, even though the business is not in thing. Okay. So this is the next section. Just give me a second. Next, at the time of transferring any asset, basically when a land and building, a capital asset is basically transferred, it must be transferred for some X amount, correct? But that X amount, the full value consideration, whatever they are saying that when it's land and building, you will also have an alternate value that is called stamp duty value. So you compare the stamp duty value and your actual consideration. So out of this two, whichever is higher will be considered as full value consideration. So if my actual consideration is 80, but stamp duty value is 100, I have to consider 100. Even though I only received 80, 100 will be my sale value. But this provision will not be applicable when the value adopted is less than 110% of the consideration received. Value adopted is less than 110%. Value adopted is less than 110% of the consideration received. So that this example gives you that only. The only thing is which date is critical. For example, 110% of consideration received, value adopted. Which stamp duty value should you take? Generally, when you're buying a land and building, you will first agree to buy the land and building. That is, on that time, you will give some advance. And then after certain months or certain period, you will go and register the property. Now, which date should you consider? Is it that advance date or registration date? Income tax says take the advance date. If even some part of money, is received in non-cash mode. So that's also where the date of agreement fixing the value is there. You have to take the date of agreement is relevant when the part of consideration is paid through prescribed mode. So date of agreement, advance date is relevant when at least some part of money was already paid through banking mode. If nothing was paid at the time of sale of agreement, automatically you have to take only the date of registration. So this is the example that is given below. I'll not take through this table. You can always go through it later or pass it and see it later. So basically the cushion is 10%. So if your actual consideration is 100, your stamp duty value should be less than if your actual stamp duty value is 100, your consideration should be less than 110% of consideration. So that is what this table is denoting. So with this comparison, compare the stamp duty value with the actual consideration. So these two talks about stamp duty value and this talks about actual consideration. When I say 100, it can be up to what, 110. But if it is 120, then automatically what will be taken? Only 120 will be taken as consideration. So this is what is covered here. And these are the examples. If sum is received in cash, the advance is received in cash, then the relevant is this date of agreement. If it is received through RTGS, the relevant date will be this 109. Here in this case, 100 into 110% will be 110. 110 is less than 109. So the 100 itself will be considered as your stamp consideration. So that is how we are calculating here. So consideration and transfer. This is discussed in section 43 CA. Moving on, section 44 AA, where we are talking about specified profession. These are the list of profession, legal, medical, and there are also some of the notified professions. If you're a newly set up profession, gross receipts, if it's more than 1.5 lakhs, you have to maintain books of account. If any other person, that is, if it's other than newly set up, last 3 years, more than 1.5 lakhs. Please remember, in all the 3 years, if it is more than 1.5 lakhs, it needs to be considered. And for everyone else, that is other than profession, if it is an individual HUF, they have to maintain. For individual HUF, they have to maintain if their turnover is more than 2.5 lakhs. Turnover is more than 2. So your income is more than 2.5 lakhs and turnover is more than 25 lakhs. So, and in any one of the 3 immediately preceding previous year, in profession, we said gross receipts more than 1.5 lakhs in all 3 previous year. But here we are saying turnover more than 25 lakhs in any one of the 3 previous year. If it is not individual, the limit goes to 1.2 lakhs in case of income from business and 10 lakhs in any one in case of sales turnover. So this is the difference between them. And who else have to maintain books of account? There are some cases where we'll be talking about presumptive taxation. So in presumptive taxation, you're supposed to maintain certain minimum profits. If you have not maintained, tax audit is mandatory. Maintenance of books of account is mandatory. So you're supposed to maintain certain minimum income in certain businesses. If you have not maintaining that, or if you have not followed any of them, then automatically you have to maintain books of account. So that's what it is about. And that is 44 AA. And when do you do tax audit? What we already saw was 44 AA, that is maintenance of books of accounts. But now we are talking about audit of accounts, that is audit of books. So AB stands for audit of books of accounts. So now when do you audit the books? If you are a business, your turnover is more than 1 crore. And if you're a digital business, more than 10 crore. When you say digital business, we are not talking about IT business. What we are saying is your collection, your cash receipt is less than or equal to 5% of total receipt. Your cash payment is also less than or equal to 5%. So if you're a business, general tax audit limit is 1 crore, but it is 10 crore when your cash receipt and cash payment both are not more than 5%. What about the profession? In case of profession, when your gross receipt exceeds 50 lakhs, it is applicable. And it is also applicable for presumptive taxation. Where you are maintaining lower profit or you have become ineligible to claim that. So this is where we say when you are ineligible to claim a particular section, automatically this comes into picture. So this is what you're calling as 44AB, where audit is mandatory. Now we have been talking about this presumptive taxation. What exactly is presumptive taxation? We will discuss about 3 presumptive taxation. All the 3 presumptive taxation are applicable only for residents, 44AD, AD, and AE. And 44AD is only applicable for individuals, HUFs and firms, not even for LLPs, Whereas 44ADA and AE is applicable for all the resident assessee. So what exactly is eligible business? 44AD says eligible business is any business other than plying, hiring or goods, because it is covered under 44AE. Any agency business, any commission business is not covered. 44ADA refers to any profession covered under 44A, accountant, consultant, technical person. All these are covered under 44A. Such persons can opt 44ADA. 44AE is about running goods, plying, hiring or leasing of goods. The condition is not more than 10 vehicles at any time during the previous year. These are the 3 different businesses. What is the turnover limit? 44AD can be opted if your turnover is up to 2 crores. 44AD when your turnover is up to 50 lakhs. 44AE, no limit. What is the limit? Up to 10 vehicles, it is allowed. So that is the only limit. So only vehicle limit, no turnover limit. What is the taxable income? What will you presume? What will you assume? Out of your turnover, 8% of turnover will be considered as your taxable income. In case if you have collected amount through digital mode, that is prescribed electronic mode, bank or credit card or whatever mode, prescribed electronic mode, then it is 6%. So to the extent collected till due date of filing return of income, you have to apply 6%. So we have to take 3 things. In case of 44AD, the turnover will be split into 3. First, it talks about received within 31st March 23. For this also, it is 6%. That is received through banking mode. And next turnover, we are talking about received till filing date. Received till filing. For this also 6%. And then not received. Not received is 8%. For not received till the filing date, it is 8%. And received in non-bank mode. This is also 8%. So you have to split your turnover into 4 categories. Received in non-bank, received within 31st March 2023 through banking mode, received within filing due date through banking mode, not at all received. So you have to apply that 8 and 6% accordingly and calculate 44AD. For 44AD, it is straightforward. 50% will be a taxable income. If my income is 40 lakhs, 20 lakh is my taxable income. If my gross receipt is 35 lakhs, 17.5 lakh is my taxable income. So it is 50% of gross receipt. So no differentiation between banking mode and cash mode receipt. All that is not covered. And what about 44AE? We said there is no turnover limit. It is based on the number of vehicles. So what you're having is it's a heavy goods vehicle. So heavy goods vehicle represents vehicle more than 12,000 kgs. For that, it is 1,000 per ton of gross vehicle. 1,000 per ton of gross vehicle weight. So, and if it is for any other asset, it is 7,500 per month, per vehicle per month. So for heavy goods vehicle, it is 1,000 per ton of the vehicle weight. Whereas for others, it is 7,500 per month for each vehicle. So that is what it is covered. Okay, the other conditions, as far as 44AD, ADA, AE, you need not maintain books of account. But if you have not followed the conditions specified in 44AD, then you are not allowed to follow 44AD for next 5 years. So if you have not followed any of the conditions in 44AD, you are not allowed to choose 44AD for next 5 years, which means for the next 5 years, you will have to maintain books of accounts. Till that, you need not maintain books of account. And when you are claiming this provision, it is assumed that all the allowances are already provided. Section 30 to 37, we said are admissible deductions. All of these are assumed to be already provided. Even partnership remuneration under 40B is also supposed to be already provided, no separate thing. For 44 AE alone, I will provide partnership remuneration. For 44 AE alone, I will only provide partnership. For AD and ADA, nothing. Everything is included within that 8%, 6%, 50%. 44 AE alone, apart from that 7,500 per vehicle or 1,000 per ton, I will also provide partnership remuneration. And these things, if it's a asset and all, I'm not going to take it. If it is basically an asset, since I'm doing presumptive basis, I can always keep a separate register where I'm calculating WDV. So whatever is WDV, as if I have provided depreciation, will be a WDV. And advance tax for 44 AD and ADA, there is only one installment out of 4. Advance tax is totally 4 installments. But for 44 AD and ADA, I have to pay only one installment. For 44 AE, there is no exceptions. You have to pay all the 4. And some of the business are partly business, partly agriculture. There are divided into 4 business: rubber, coffee grown and cured, coffee grown, cured, roasted and grounded, tea. So these are the 4 business. So for rubber, it is 35%. For coffee grown and cured, it is 25% of business. For grown, cured, grounded and roasted, it is 40%. And finally, if it's a tea business, it is 40%. So that is your business. And this is your agriculture. What about your agriculture? The balance will be treated as agriculture. Why do you split this? You split this because this is exempt. This proportion will be exempt. The business proportion will be taxable. So I take the total profit, I divide it into this ratio of business and agriculture. Clear in that? So that is why I have to calculate for partly business and partly agriculture. Section 28, I told you, is a charging section which talks about what is treated as business income. I'll not go through this independently. So any profit from business, any incentives from business, any amount received by a partner as salary, remuneration, whatever it is, any amount received by a partner, all these are basically called as your income from business or profession. So all these are what you call it as business or profession. And similarly, whenever there is change in any conditions, there is an agreement between 2 people. If there is any modifications or changes, similar to salary. In salary also, we said, when there is any change in employment agreement, it will be treated as salary. Here also, any change in agreement, any modifications to the agreement, it will be treated as my business income. So that is all about section 28. So now we are done with PGBP. We have covered all the sections right from section 30 to 43B. Now we'll move on to the next head, the 4th head of capital gain. So capital gain is basically, we all know that it is relevant to a capital asset. So of course, we have to know what is a capital asset. So property of any kind will be treated as capital asset. It may be connected with your business or may not be connected with your business. But in case of shares, if it is invested by a foreign institutional investor, irrespective of the situation, it will only be capital gain. Generally, share could be a business income also, could be a your capital gain also. But if it is foreign institutional investor, basically a foreign investor investing in shares can only be capital gain. He can never do business with shares. And next is any unit linked insurance policy. I will stop here and will not tell anything more because it's not applicable for your intermediate level. So unit linked insurance policy, blah, 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 is not applicable for you. So I'm not going to talk to you. But when you talk about capital asset, we need to understand that certain assets are not capital assets. Stock in trade are not capital asset. Rural agriculture land are not capital asset. Gold bond or special bearer bonds are not capital asset. And similarly, any personal assets that is movable, is also not capital asset. So when you say personal effects, they are giving you some exclusions, which means these are personal, but it is still capital. So when we said personal assets are not capital, but these personal assets are capital. Which personal assets? Jewelry, archaeology related, sculptures related, drawings related, and artwork. These five items, even though it is personal in nature, it will be treated as capital asset. So this is what capital asset is about. Generally, capital asset is divided into short term and long term. Short term has a limit of 36 months. Any asset that is held till 36 months will be called as capital asset, short-term capital. Otherwise, it will be treated as long-term. But it is not 36 months for all the assets. There are some exceptions. For some assets, period of 12 months, less than 12 months is short-term, more than 12 months is long-term. Listed securities, unit of mutual funds, zero coupon bond. For these three assets, 1 year, less than 1 year is short-term, more than 1 year is long-term. Unlisted shares, land or building. For these two, it is 24 months. Up to 24 months, it is short-term. More than 24 months, it is long-term. So that is about unlisted shares and land or building. What about any other capital asset that comes under 36 months? Any other asset that comes under 36 months. So that is your short-term. So generally 36 months, but for listed shares, unit of mutual funds and zero coupon bond, it is 12 months. For unlisted shares and land or building or both, it is 24 months. For everything else, it is 36 months. So of course, then what do you mean by long-term? Anything which is not a short-term is called a long-term. Now you have to calculate the period of holding, right? From the date of purchase to date of sale. This is what you're talking about, the period of holding. But certain situations, the period of holding will vary. Generally, date of purchase, date of sale. But when it is transferred to a previous owner, father giving to son, received as a gift. In these situations, the period of holding should be from the original owner, that is from the previous owner. Similarly, sometimes preference share is converted into equity share. For period of holding, calculate from preference share, preference share to equity share, debenture to equity. So for all of these things, I have to calculate from the original date. Similarly, allotment date, period of holding, when it's right shares or something, I have to calculate from the allotment date. So there will be a lot of pages in your study material talking about the period of holding is different. Everything will boil down to these 3 points. Previous owner, previous form, allotment date. Previous owner, previous form, previous allotment date. So these 3 situations, period of holding should be from the original date, not from the subsequent date. And the initial transfer, that is father to son, will not be treated as a transfer. So finally, when it is sold, only then it will be treated as a transfer. So when will it be considered for capital gain? When it is finally sold. Preference share conversion to equity share, it is not capital gain. Finally, when the equity share is sold, it is capital gain. What will be the period of holding? From preference share to equity share. Father gifting a house property to son. It is not a sale of capital gain. It is not a capital gain. But when son is finally selling it, it is a capital gain. What is the period of holding? From father to final this date. So you have to remember this, only 3 key points: previous owner, previous form, allotment date. It's such a short way I'm telling you to remember. Your study material has n number of pages for this. Please remember, all of this will boil down to previous owner, previous form, allotment date. Initial transfer in these cases will not be regarded as transfer. So that is about period of holding. So generally capital gain will be taxable in the year of transfer. So it is not about receipt of money, it is year of transfer. So in the previous year in which the transfer took place is when you will recognize capital gain. But there are some exceptions to this. For example, insurance receipt. When there is my asset has gone in flood or civil disturbance or some fire accident or something, enemy has destroyed my asset. So if something has happened to my asset, or stock or something, now this asset is now destroyed. So now it is a transfer. Even destroying an asset is a transfer. But after 2 years, I'm receiving insurance receipt. Insurance receipt is taxable in the year of receipt. So let's say fire happened in 2022. Insurance is received in 2024. This is the period I have to recognize capital gain. This is the year I'll recognize capital gain. This insurance receipt could either be in cash or could be a replacement asset. If it is a replacement asset, the fair market value of that asset will be considered. Otherwise, the date of receipt will be the date of taxability. So even though your asset was demolished in 2022, no capital gain now. Only when you're receiving your insurance receipt, it is taxable as capital gain. So that is for thing. So this is the sale consideration, other thing. And in another situation, conversion. conversion of stock in trade, that is capital asset is converted into a stock in trade. So till the date it is converted to a stock in trade, it is capital gain. Finally, when it is sold, it is business. So there are two elements. Purchase date to stock in trade date is capital gain. Stock in trade to final sale is business or profession. So this is what we are saying. When do you recognize? You recognize when the stock in trade was finally transferred. I purchased the asset. Let's say in 2018 as capital asset. In 2021, I'm converting this into stock. In 2023, I'm selling. So this period is capital gain. This period is PGBP. So that is what we are saying. So what is capital gain? Fair market value on this date. Fair market value on this date will be the selling consideration. It will also be the purchase cost. Selling consideration for capital gain, purchase cost for business. So fair market value will be the selling consideration for capital gain, will be the purchase cost for business profits. Indexation will be done only till the time of conversion. That is, indexation will be only till 2021 and not till 2023. So that is what we have to do for stock in trade. So this is what is explained here. And we are talking about reinvesting this into a subsequent asset, that is 54 EC. Capital gain can be invested into bonds. The 6-month period for bonds is eligible from the sale of stock, that is from this date. Sale of this date, and not from the conversion, not from 2021, but from 2023. So that is what we have to take. And another situation is compulsory acquisition. We have been seeing a lot of metro works in Chennai. There will be compulsory acquisition. Land will be taken over by government. You don't have an option. You have to give it. Only condition is you have to receive the market value. So when you're receiving some money, sometimes what happens is, let's say the value is worth 2 crores, but I'm receiving only 1.5 crores. I'll make an application for getting extra 50 lakhs. So when I'm getting this enhanced compensation, it is taxable only in the year of receipt, So in that year, I will straight away treat it as capital gain and charge it. There is no cost of acquisition, no cost of improvement. Whatever is received will be taxable. But if I've received any interest along with that, 50% of interest alone is taxable, not the whole interest. What will be taxable is only 50% of interest, not the whole interest. In case subsequently it is reduced, let's say 1.5 crores was increased to 1.8 crores, 30 lakh is enhanced compensation. Let's say it is subsequently reduced to a certain amount, then there will be a recomputation done and it will be refunded. Whatever is there will be refunded accordingly. Interim order is basically compensation received. When do you take this date? The date in which it is taxable will be the interim order date. We said year of receipt, right? Year of receipt is nothing but the order date. In case if the person is no more at the time of death, the recipient will pay tax. All logical, nothing. The only thing we have to remember is this portion. Compensation is taxable in the year of receipt or the order year, interim order year, whichever is earlier. And when you also receive interest along with it, only 50% of interest, half of the interest alone is taxable. Balance half will be claimed as deduction under section 57. That is income from other sources. Okay, so that is compulsory acquisition. Now, how do you calculate capital gain? You have sale consideration, the manner in which we saw now, less expenditure, that is selling expenditure. You get net sale consideration. On net sale consideration, you reduce cost of acquisition and cost of improvement. The resultant will be capital gain. But in case if it is a long term, cost of acquisition will be index cost of acquisition and cost of improvement will be index cost of improvement. So any amount paid on security transaction tax shall not be allowed. That is STT. STT will not be allowed as an expenditure for the purpose of capital gain. We said indexation on long-term capital assets, but indexation is not available on transfer of bonds or debenture other than capital index bond and sovereign gold bond. So the word indexed is there in the bond name itself. Only for that bond you are eligible, and then you are also eligible for sovereign gold bond. Only for these two bonds, indexation is allowed. For any other bond, any other debenture, indexation is not available. Indexation is not available for any depreciable assets. Indexation is not available for any non-residents who's transferring shares or debentures in an Indian company. So indexation is also not available for non-resident on transfer of shares. Equity share where STT is paid at both the time. That is long-term capital gain on equity shares, listed equity shares, where security transaction tax is paid both at the time of purchase and at the time of sale. That is covered under section 112A. Indexation is not available for that also. Similarly, mutual fund units where indexation is paid at the time of transfer, So for this also, there is no indexation. So these two are, even though it is long term, there is no indexation. Even though it is long term, there is no indexation. And when you say index cost of acquisition will be from the first year in which the asset was held by the assessee. First year in which asset was held by the assessee, or April 2001, whichever is later. So if the asset was purchased before 2001, I have to take 2001 as the base year. If it is after 2001, the actual year. So that is what indexation is all about. But please remember, when you say indexation about, we said that in some cases, previous owner, previous form will be there. For such people, the cost will differ. So for example, cost of the previous owner should be taken for whom? Wherever it is on distribution, it is on gift, it is on succession, it is on again on distribution of assets at the time of liquidation or the time of trust transfer through a trust. During these situation or amalgamation, demerger or something, during these situation, the previous owner value will be considered. So father giving to son, cost of father is also the cost to the son. So when you're indexing, the word is used as asset was first held by the assessee. In this case, the asset will be, say, let's say father to son under gift or succession. The asset would have been first held by the assessee is the son. Son is the one who's finally selling. So the question came out, should I take the year which was first owned by the son? Let's take an example. Father purchased in 2018, given to son in 2022, sold in 2023. Now for indexation, should I index it from 2018 or should I index it from 2022? The question says, the literal reading of the law says from the time it is held by the assessee, which means it must be considered only from 2022 and not from 2018, But there is a case law from Bombay High Court. Case laws are not required for intermediate, but this case law is relevant. Unless you quote this case law, your answer is not correct. So when you're reading question where it is about succession, father has given to son or something, in such cases, indexation will happen from 2018 only, but it is based on the case law of Manjula J. Shah, CAT versus Manjula. Only based on this case law, you are indexing it from 2018. Otherwise, you can only index it from 2022. So quoting this case law is very important, Unless you quote this, your answer is not correct. In such situation. So this is what is said. So we are just taking into consideration. So we'll leave this example. We'll move on to next cost. Now the cost that we saw is where the previous owner is different, the current owner is different. The previous owner is different, the assessee is different. Father, son, amalgamation, merger, demerger, all these we saw. The original owner is different, the current owner is different. The one who is selling is not the original owner. So that's what we saw. Now what we are going to see is cost for specific asset is discussed in section 55. First, we are going to talk about goodwill. For goodwill, if you have purchased goodwill, purchase price minus depreciation till previous year 1920. So depreciation should be provided only till previous year 1920. So this depreciation is only till this. After previous year 1920, no depreciation. After previous year 1920, from 1st April 2020, no depreciation. So purchase price minus depreciation till 31st March 2020. If it's self-generated, no, nothing. The cost is nil. If it is a share, bonus share, before 2001, it is a fair market value. After 2001, it is zero because there is no cost for bonus share. What about right share? If right share, you are not taking up the right share, you have given it to someone, renounced to another person, then the cost will be nil. What will be the cost to another person? For example, I own shares in company ABC. Company is giving me right share. I am giving it to Mr. X. Now, what will be the cost of the right share to Mr. X? It will be whatever is paid to me, whatever he has paid to me, plus whatever he has paid to company. Whatever he has paid to me, plus whatever he has paid to company will be cost to another person. In case I myself am subscribing, whatever I'm making payment is what is basically. So subscription charges will become my cost. In case I'm giving it to someone else, the other person cost will be what he has given me plus whatever he has paid to the company. So that is what is there. In the scheme of demutualization or corporatization, we'll not get into this. Basically, what is demutualization is basically there is a particular organization which is getting converted into a stock exchange. So the membership charges which I pay at the time is what will become a cost. This is totally irrelevant for examination. I don't think you'll be tested on this, so we'll leave it. Any other capital asset before 1st April 2001, fair market value or cost, whichever is higher. Fair market value or cost, whichever is higher. In case it is a land or building, you should also consider stamp duty value. So fair market value or stamp duty value, whichever is higher, you have to consider. If the cost is also provided, cost or fair market value, whichever is higher. And any cost of improvement till 1st April 2001 will not be considered. What about if it is distributed as gift or something? We already said cost to the previous owner, cost of improvement of the assessee plus cost of improvement of the previous owner. And what about long-term capital asset under section 112A? Higher of cost of acquisition, lower of fair market value or sale consideration. So first I identified lower of fair market value or sale consideration, and then I take higher of cost of acquisition. It is something like your house property, standard rent or fair rent, whichever is higher, subject to maximum of fair rent or municipal rent, whichever is higher, subject to maximum of standard rent. Adhe marida ingeyum, they are saying that higher of cost of acquisition and lower of fair market value and sale consideration. The first step 1 is this. Step 2 is this. So first I take lower of fair market value or sale consideration, then I take higher of cost of acquisition. So that is what it is about. So this is what? This is only applicable for shares purchased before 1st February 2018. 1st February 2018. So the fair market value is nothing but fair market value is highest price quoted on 31st January 2018. Highest price quoted on 31st January 2018. If it is not listed, net annual value on 31st January 2018. If it is not listed and what are these two confusions, you can leave it. What is relevant for exam is this. Whatever is relevant for exam is only this. So anything purchased till 31st January 2018, fair market value on 31st January 2018 will be compared with sale consideration. Whichever is lower will be taken. That will be compared along with cost of acquisition, whichever is higher. So this is how we calculate cost of acquisition for cost of asset for listed equity shares under section 112A. What about depreciable assets? We said depreciable assets will be recognized when my WDV becomes negative. WDV becomes negative or the entire block ceases to exist. I have 3 cars. I've sold all the 3 cars. So that is this case. I have 3 cars. I'm selling one, but the cost of one is greater than WDV of 3. The sale of value of 1 car is more than the WDV of 3 cars. So that means my WDV becomes negative. So what will be the capital gain? Net sale consideration. Net sale consideration. So short-term capital gain will be net sale consideration minus opening WDV minus cost of asset acquired during the year. So this will be my short-term capital gain. Depreciable asset is always short-term. It is never long-term capital gain. It is always short-term capital gain. It is never long-term capital gain. And what will be the formula? As net sale consideration minus opening WDV minus additions during the year will be considered as my depreciable asset. And there is another concept called slump sale. Basically, I'm selling my entity as a whole. So my capital gain will be net sale consideration minus net worth. What is net worth? Value of assets minus liabilities. Asset minus liability. What is my value of assets? WDV of depreciable assets. Nil in case of 35 AD assets. For goodwill, whatever is the actual cost, that is acquired cost. If it is self-generated, it is nil. Plus book value of other assets. If I combine all these, I get my aggregate value of assets minus liability of my undertaking, And what is my net sale consideration? It is higher of FMV1 and FMV2. So what is FMV1? Fair market value of capital asset transferred. Whatever asset is transferred, the fair market value is FMV1. What is FMV2? Fair market value of monetary and non-monetary consideration. Fair market value of monetary and non-monetary consideration. So whatever I've received in cash, plus if I've received in some form of shares or something, fair market value of that. So fair market value 2 is what that is about. So fair market value 1 or FMV2, whichever is higher, will be treated as net sale consideration. In fact, will be treated as sale consideration. So finally, I arrive at net sale consideration. What is my cost of acquisition? Net worth is my cost of acquisition. What is my net worth? It is value of assets minus liabilities. What is my assets? It is WDV of depreciable assets. Nil in case of 35 AD assets. Goodwill, if it is acquired, actual cost. If it's self-generated, it is nil. Book value of every other assets. So now, when it says slump sale, we said unit as a whole. So all the assets and liabilities are transferred. So here what they say is, how will I calculate long-term or short-term? It will be calculated based on the time of undertaking. That is, when was this unit set up? When is it finally being sold? So the unit setup date to sale date. So this period, setup date to sale date period, if it is more than 36 months, then it is LTCG. Otherwise, it is STCG. And to claim this slump sale, a certified chartered accountant certificate should be submitted before the due date specified under section 44AB. So we'll not discuss about due dates right now. We'll leave it. And similar to section 43CA in your 43CA in PGBP, here you have sections like 50C, CA and CD. So 50C is basically for land and building. So asset is land or building, similar to 43CA what we saw. Not applicable when stamp duty value is less than or equal to 110%. So that is for PGBP. This is for capital gain. Same thing. If I need to take date of agreement, if there is an advance provided through banking mode, if there is no advance provided or advance is provided in cash, I'll take date of registration. So that is typically for calculating your which stamp duty value to consider. 50CA is unquoted shares. If your consideration paid is less than the fair market value, then fair market value will be treated as consideration. Let's say the share is actually worth 100, but I'm only paying 80. So 100 becomes my fair market value. If it's any other asset, fair market value, if consideration is not ascertainable. If for any other asset, if I'm not able to understand how much consideration has been settled, fair market value of that asset will be treated as sale consideration. So this is similar to 43CA, which we have already discussed. So I'm not spending much time. And we'll move on to the next section called as advance. When you say advance, till financial year 13-14, that is advance received till 31st March 2014, it will be adjusted with the cost. So my cost of acquisition will be actual cost minus advance retained. That is till 31st March 2014. But from financial year 14-15, financial year 14-15, from 1st April 2014, the forfeited advance will be treated under IFOs, will be treated under income from other sources. Such advance will not be reduced from cost of acquisition. So till that, even today, even in your examination, the question says that advance was received in 2013 or 2012, it should be adjusted with the cost. If it says it was received after 1st April 2014, it will not be adjusted to the cost. It will be treated as income from other sources. The next one is compulsory acquisition of urban agriculture land. Generally, rural agriculture land is not at all an asset. Rural agriculture land is not at all a capital asset. So rural agri land is not a capital asset. Urban agriculture land is a capital asset. But if it is compulsory compulsory acquisition of urban agriculture land is exempt under section 10, clause 37. So after 1st April 2004, if there is any compensation received for compulsory acquisition of urban agriculture land, then it is exempt, provided that land was used for agriculture purpose for preceding 2 years by the individual or the parent of the individual or the HUF. So the condition is it must be an urban agriculture land. Such urban agriculture land should be used for agriculture purposes for 2 years, either by himself or by the parent. And such land should be compulsorily acquired, Then both the regular compensation and the enhanced compensation, both the compensation and the enhanced compensation is not taxable, is exempt under section 10, clause 37. So this is about your capital gain things. Moving on, we'll move on to the exemptions. I'll cover like around 5 exemptions, which is important for examination. First 2 we'll be comparing is between section 54 and 54F. 54 and 54F, one common thing is in both these sections, in both section 54 and 54F, you're supposed to buy a residential house property. You're supposed to buy a residential house. So you're supposed to invest in residential houses. For 54, an assessee must be an individual or HUF. The capital gain should be long-term capital gain. The asset that is sold should be a residential house, and such residential house should have been treated under income from house property, and he has newly invested in another residential house. So sell residential house, buy residential house. When should you buy this? 1 year before or 2 years after. 1 year before or 2 years after. In case if you are constructing, 3 years after. What about 54F? Here also it is applicable for individual or HUF. It is only applicable for long-term capital gain, and it refers to any asset not being residential house. So it is specifically what is not covered in 54. That is, I'm selling an asset which is not a residential house, and at the time of sale, at the time of purchase of new house, at the time of sale of new house, I should not own more than one house on the date of transfer. So apart from the new house that I'm going to buy, I can only have one more house. So that is the restriction. And what should I buy? I should buy another residential house only 1 year before or 2 years after or 3 years after for construction. One more thing that you need to understand is if it is 54, if it is section 54, I can also buy 2 houses instead of one house. I can also buy 2 houses if my capital gain, if my long-term capital gain is less than or equal to 2 crores. So I can buy 2 houses in such cases. If it's more than 2 crore, I don't have this benefit. If it is less than or equal to 2 crores, I can go for an option of 2 houses. I can invest in 2 independent houses. Generally, you can only buy one house, but only in this situation, you can buy 2 houses. Now, what is the exemption? Capital gain or the cost of new asset, whichever is lower. So because of exemption, my capital gain cannot be negative. Because of exemption, my capital gain cannot be negative. So capital gain or cost of new asset, whichever is lower. Only thing that you have to remember is once this option of 2 houses is exercised, I can never choose 54 again. So 54, if I have chosen this 2 house requirement, that is the only time I can apply 54. I cannot apply it any time in any other assessment year. And what about 54F? It's a proportion. I have sold a property for which the net sale consideration is this much. for which my capital gain is this much. Now I am buying a new asset, what will be my proportion? So cross multiplication, new asset into capital gain divided by net sale consideration. So I identify this proportion, cross multiplication, net sale consideration, this much is my capital gain. How much is it for my new asset? So new asset into capital gain divided by net sale consideration. Doing this cross multiplication, I will get what is my exemption. But anyways, it is restricted to maximum of capital gain. As I told you, capital gain cannot be negative because of exemption. And one critical thing is, if the new asset is transferred within 3 years, if the new asset is transferred within 3 years, then this exemption will be withdrawn. This exemption will be withdrawn. Whatever was treated as exemption earlier will become taxable, But in case of 54F, not only the new asset is sold within 3 years, if I have purchased one more house, if I have purchased another house, I will not satisfy the condition of not more than one house at the time of transfer. So if I'm purchasing another house, I will not satisfy the condition of not more than one house at the time of transfer. So during the entire tenure of the first 3 years, I should own only one house other than this new house. One house other than this new house. So that is what they're talking about. The capital gain earlier exempt shall be deemed to be long-term capital gain. So in both cases, whatever is given as exemption will be treated as long-term exemption. And what will be my treatment? The adjusted cost of acquisition will be cost of acquisition minus capital gain exempted earlier. So my cost of acquisition will be minus capital gain exempted earlier. So this is how I compute my capital gain if I am selling it within 3 years from the time of claiming the exemption. Capital gain scheme is available. What is capital gain scheme? If I'm not able to buy any house within the return filing due date, I have to buy it within due date of return filing. If I'm not able to buy it, I invest that money because I still have time for plus 2 years or plus 3 years. So when I'm not able to buy it, I'll invest it into another house. And what about 54B and 54D? 54B is for agriculture. I sell agriculture, I buy agriculture land. I sell an agriculture land, I also buy an agriculture land. Selling agriculture land is an urban agriculture land. It could either be short term or long term. Only thing is it must be used for agriculture for 2 years. I have to buy another agriculture land within 2 years. And my exemption is capital gain or cost of new asset, whichever is lower. My exemption will be taken away if I am buying, if the new asset is transferred within 3 years. If the new asset is also an urban agriculture land, if that is transferred within 3 years, it is there. The withdrawal is not applicable if the new asset is a rural agriculture land, because rural agriculture land is not at all a capital asset. So withdrawal is applicable only when the new asset purchased was an urban agriculture land. So capital gain scheme is available. What is 54D? It could be for any SSC, short term or long term. I have a land or building. It is compulsorily acquired, which was used for manufacturing for 2 years. Previous 2 years was used for manufacturing. Now this land was compulsory acquired. I am moving to a different location, re-establishing, setting up again. So capital gain or cost of new asset, whichever is lower repeated. If such new asset, the re-established asset is transferred within 3 years, the capital gain will be withdrawn. Capital gain scheme is available. So this is also there. Last provision that we'll be seeing is 54EC. For 54EC, any SSC long term, what must be the asset that is sold as land or building or both, including depreciable asset. Only thing is, it must be invested into a bond redeemable after 5 years. Bond for a period of 5 years. What are the bonds listed? National Highways Authority, Rural Electrification, Power Finance Corporation, Indian Railways Finance Corporation. So if I'm buying any of these 4, the bond will be redeemable after a period of 5 years. It's there. Within 6 months, I have to invest it within 6 months from the date of transfer. So capital gain or the cost of new asset, whichever is lower is eligible for exemption. But there is one more condition. Maximum eligibility is only 50 lakhs. 50 lakhs during the current year and subsequent financial year. So which means if I'm selling a property in financial year 22-23, my investment should be within 6 months. If my sale date is 31st March, let's say 1st March 23, I have to invest within 6 months. So March, April, May, June, July, August. So now for this entire 6-month period, the total limit is 50 lakhs, which means current financial year 22-23 and financial year 23-24, both put together, my maximum limit is only 50 lakhs. And it will be withdrawn if the new asset is transferred within 5 years, because it's a restriction period of 5 years. So if I'm transferring the bond within 5 years, or if I obtained any loan based on that bond within 5 years, then it is taxed as long-term capital gain. Capital gain scheme is not available because the time available is only 6 months. However, deduction under ATC shall not be allowed for investment made in long term. Since you have claimed exemption here, you cannot claim if you are eligible for any deduction under section ATC. So that is 54 EC. So moving on, we'll understand the different tax rates for thing. First, we'll understand about short-term capital gain under section 111A. So short-term capital gains under section 111A is basically where it's a listed equity share. So where equity share of a company or a mutual fund or a business trust where STT has been already levied. So the cutoff date is 1st October. After 1st October only this provision is applicable. So after 1st October 2004, if on equity share or mutual fund unit or business trust unit, if STT has been levied, then the tax rate is 15%. The tax rate is 15%. We will skip this part. We'll skip this part. The following needs to be considered. The benefit of availing basic exemption limit is not available for non-resident. Non-resident cannot avail basic exemption limit. In this situation, deduction under Chapter 6A also cannot be availed. So these two things you have to keep in mind. Chapter 6 deductions are not allowed. Basic exemption limit is not available for non-resident alone. The tax rate is 15%. What about next thing, 112A, that is specifically for long term. Here also it is for equity share, mutual fund and unit of business trust only. What you have to keep in mind is security transaction tax should be at the time of both purchase and sale for equity share. For mutual fund and business trust unit, it is only at the time of selling security transaction tax should be applicable. Long-term capital gain, if it is more than 12 months. For trust alone, if it is more than 36 months. One thing that you have to keep in mind is for long-term capital gain under section 112A, there is no capital gain up to 1 lakh. So first to 1 lakh, there is no tax. Only when your long-term capital gain under section 112A exceeds 1 lakh, it is applicable. Here also, I will not treat at this point. Following needs to be considered. Basic available is not available for non-resident. Chapter 6A is not eligible. 87A rebate for income up to 5 lakhs is also not allowed. Is also not allowed for 112A. So these are all the things. What is the tax rate? 10%. Short-term capital gain for similar situation is 15%. Long-term capital gain is 10%. There is an example to understand about a thing. We already said, I'll just repeat it. Fair market value or sale value, whichever is lower. This is compared with cost of acquisition, whichever is higher. This is how we do. You can repeat for all of this and see how it goes. So this is what it must be carried out. And what about other capital gain? Other capital gain, long-term capital gain under section 12. So for any other long-term capital gain, if it is listed securities or zero coupon bond, it is 10% without indexation or 10% with indexation, whichever is beneficial. Whichever is beneficial can be taken. 10% without indexation or 20% with indexation. And what about unlisted shares of private companies for non-residents? It is 10% without indexation and foreign currency fluctuation. For any other assets, it's 20% with indexation. Mostly listed securities will get covered under 112A. But in case if it is not covered there, then it will get covered here. In that case, it is 10% without indexation or 20% with indexation. For unlisted shares of private companies for non-resident, it is 10% without indexation, without foreign currency fluctuation. For every other asset, it is 20%. Things to keep in mind: no basic exemption limit for non-resident, no Chapter 6A deductions. So in all these three sections, 111A, 112 and 112A, no basic exemption limit for non-residents, no Chapter 6A deductions. Only for 112A, there is one more thing: no rebate under section 87A. So with this, we have completed our capital gain. So we have all completed capital gain as such. So now after completing capital gain, we are left with one last head of income, that is your income from other sources, income from other sources. So that is the last head of income that we will be discussing today. Looks like a real marathon, right? We are rushing through so much in short space of time. So much have been covered. By now itself, we have already covered three heads of income. We have covered business, we have covered house property, and we have covered capital. And I can't even understand that I've covered house property in within 15 minutes. But I've covered everything, of course. Don't think otherwise. I've covered everything, but I've just covered it in 15 minutes. That's a kind of record time. Okay, we'll move on to the last topic, heads of income, other sources. So income from other sources is your last head of income of the 5 years. So what exactly is income from other sources? It covers under 4 sections. 56 is the charging section, which tells that income from certain incomes are chargeable under income from other sources. 57 is for deductions that can be claimed, deductions that can be claimed for income from other sources. 58 says these deductions are not allowed. 58 says these deductions are not allowed. 59 says deemed income. It is similar to section 41 in PGBP. Section 41 in PGBP. So it's a deemed income. It will be considered as income. And what is the computation structure? Income under section 56, deemed income under section 59. I reduce all the allowable expenditure under section 57. I get my income from other sources. So now we are going to understand these sections. That is basically we are going to understand all these 4 sections. Sorry. So we'll start with section 56. First thing that we'll discuss about dividend. Okay. Dividend could be any of these 5 years. I'll not take through much in detail. So it could be any type of dividend. First to 4, that is A, B, C, D, or common things. Probably you yourselves can go through and understand. Fifth thing alone is called as Fifth point alone is called as any payment by a private limited to a shareholder who owns more than 10% or more of equity share capital, any concern in which a shareholder is a member. So basically, a company, a private limited company is giving to one of the shareholders who's owning more than 10% in form of loan or something, but otherwise this would have been dividend. So in such cases, it will be treated as deemed dividend. But anyways, this is not applicable when it is a proper business transaction. When it is a proper business transaction, commercial transaction, proper business transaction, it will not be treated. And subsequently, when dividend is received, this will be reduced. If I'm giving 100 today, this will be treated as deemed dividend. 2 years later, I'm giving a dividend of 120. At that time, 120 minus 100, that only will be treated as dividend income. That's what is gain. So basically, dividend is only to the extent of accumulated profits. Anything outside your accumulated profits will not be treated as dividend. And dividend is taxable at normal rate of tax. There is no special rates for dividend. The next income from other sources that we'll be understanding is casual income. 56 subsection 2, clause 2 provides casual income. What are casual income? Your lotteries, your crossword puzzles, your races, your card games and other games of any sort, gambling or betting of any form or in whatsoever manner. So all these things will be treated as casual income. One thing that you have to keep under casual income is no expenditure. So no expenditure can be claimed. Chapter 6A deductions are not allowed. Adjustment of unexhausted basic exemption limit is also not permitted. So here I'm not talking only about non-resident. The adjustment of unexhausted basic exemption limit is not available for anyone. Deduction under chapter 6A is not available for anyone. No expenditure is also not allowed. So that is your casual income. And what is the tax rate? It's a flat 30%. So there is no slab rate for casual income. It is flat 30% for any of these income. And the next income that we'll be talking about is excess of fair market value. What is excess of fair market value? Basically, a consideration is received by a company, that is by a private limited company, and it is receiving in excess of fair market value, which is my actual share value, my actual floor price. That share price is, let's say, 10 rupees. I am issuing it at premium. I am issuing it at premium of 25 rupees. but the actual fair market value is only 20. So which means my actual worth is only 20, but I'm issuing it at 25. So 25 minus 10, 25 minus 20, 5 will be my income from other sources because it's excess of fair market value. So whatever is in excess of fair market value will be applicable when shares are issued at premium. So this provision is applicable only when shares are issued at premium. It is not applicable otherwise. So fair market value shall be higher of value determined as per prescribed method or substantiated by the company before the assessing officer. So I take the fair market value based on the valuation identified or by whatever is being given by the assessing officer. And basically, consideration received minus fair market value. How much was consideration received in our example? 25. How much is fair market value? 20. So 25 minus 20 will be 5 will be my income. So this is considered as capital in lieu of income. This is considered as capital in lieu of income. So it is generally an income, but I'm taking the characteristics of capital to avoid tax. So that's what's the intention. So it is generally an income, but I'm taking the characteristics of share capital to avoid taxation. So this example also will be given. For example, B Limited is not a private limited, so it is not applicable. For in other cases, it is applicable. And this is what it is about, right? So these are all the examples that we have discussed. You can always go through and see how exactly it is calculated. So excess of fair market value. Next thing we are going to understand is one of the important sections that is tested in your exam, 56 to 10, is basically called as gift. Gift could be 3 categories. It could be cash, it could be immovable property, it could be movable property. So these 3 concepts. Now, what is exactly a property? Be it immovable property or movable property, what exactly is property? Property includes immovable property, that is land or building or both, shares and securities, including virtual digital asset. So VDA is your virtual digital asset. All your cryptocurrency, everything falls under this VDA. So then you have jewelry. Then you have archaeological collections, drawing, painting, sculptures, any work of art, bullion. So if you actually look at it, all these are what we discussed as personal assets. Personal assets, but still capital asset. It is personal, but still capital asset. So this is what we are calling it as property defined. Anything that is not part of these 9 items, anything that is not part of this 9 item is not property. So if someone is gifting a car is not covered under property. So it is not income from other sources. It is not at all taxable because car is not covered under the property definition. So please remember this. Only these 9 assets are covered here. Only these 9 assets, that is immovable plus 8 assets. So this is 1, this is 8. So only these 9 assets are covered as property. Nothing else is covered. And it is covered only when it is held as capital asset. It is not applicable when it is given as stock in trade. So that is also needs to be considered. Now, we'll first start with money, any money. Okay, we'll start with any money. So basically, when you say any money, it is typically, what? It is any sum of money. Person receives any sum of money without consideration for no services provided. It's like a gift, birthday gift, wedding gift, whatever it is. The aggregate exceeds 50,000. The aggregate exceeds 50,000. So up to 50,000, it's not taxable. If it crosses 50,000, the entire amount is taxable. So entire amount becomes taxable. The limit prescribed is not per person. Please remember, it is 50,000 per year. 50,000 per year. So if it is crossing 50,000, the entire amount, the whole sum will be treated as gift. So that is what we are talking about. And in case of any other property that is other than immovable property, if it is without consideration, whatever is the fair market value will be treated as gift. But if the fair market value is not more than 50,000, if the fair market value is not more than 50,000, then it is not at all a gift. Then it is not at all taxable. If you are receiving some consideration, then fair market value minus consideration received. If that is more than 50,000, it is considered. If that is less than 50,000, it is not taxable. So any other property, that is 8 properties, the 8 properties that we discussed, in these 8 properties, if it is issued without consideration, the fair market value will be treated as gift income, provided it crosses 50,000. Otherwise, if it is with consideration, fair market value minus consideration received If it crosses 50,000, it becomes straight away taxable. What about immovable property? If it is received with consideration, I take stamp duty value less consideration receipt. Stamp duty value less consideration. What date of stamp duty value? Similar to what we discussed in 43 CA. Depending upon whether advance was received in cash or kind, cash or bank mode, it depends. So that's what is about. So stamp duty value less consideration receipt. If it is 50,000 or 10% of consideration, whichever is higher. So 50,000 or 10% of consideration. For example, if my stamp duty value is 60 lakhs, okay, and my consideration received is 40 lakhs. So the difference is how much? 20 lakhs, correct? The difference is 20 lakhs. So now 10% of consideration, 10% of consideration is how much? 6 lakhs, 4 lakhs. So 10% of consideration is 4 lakhs. This is 50,000. Since 20 lakhs is more than 4 lakhs. Since 20 lakh is more than 4 lakhs, 20 lakh will be treated as gift. So 50,000 or 10% of consideration, whichever is higher. If my difference is more than this difference, more than this amount, then it will be treated. If it's without consideration, the stamp duty value is more than 50,000, it will be treated as gift. If the stamp duty value is more than 50,000, it will be treated as gift. So that is what you're calling it as any immovable property. Okay. So that is one thing. As I told you, it is not applicable for capital. It is applicable only for capital asset. It is not applicable for stock. And when I say gift of 50,000 in cash, sum of money more than 50,000 or property, immovable property or any property, the provision is not applicable if it is received. It is not applicable if it is received from any relative, marriage of individual. On the wedding date, if you received something under will or inheritance, that is succession, death to legal heir, from any local authority, any institution could be educational institution, medical institution, it could be there. Any trust which is registered under section 12AB, not a transfer under section 47. So that is gift or succession or whatever it is, and any other prescribed person which could be denoted. So if the gift is being received from any of these, from any relative, from any of them, I have received a gift, or it is given to a trust or given to a institution, it is given to a trust or institution, then such receipt will not be treated as gift. So now, whom do you call relative? Spouse of individual, brother or sister of the spouse and brother or sister of either of the parents, lineal ascendant or descendant. So ascendant is basically father, grandfather, great grandfather. Descendant is basically son, grandson, great grandson. So for these people, it is not applicable. Lineal ascendant or descendant of the individual, lineal ascendant or descendant of the spouse also. And in all these cases, if I refer my grandfather, my grandmother is also included. If I refer my father, my mother is also included. If I refer my son, my son's wife is also included. So that is what is discussed in this particular clause. In case of HUF, it's very simple. Any member thereof alone is called as a relative. Everyone else will not be called as relative. Okay. Moving on. Prescribed persons we already discussed. This gift, whatever we have received, we have to keep one thing in mind. We said from relative, from this, blah, 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 are not taxable, right? From gift, from education institution, hospital, trust, all these things, we said it's not taxable. Apart from this, FA 22 says even amount towards COVID relief is also not taxable. So what do you mean by COVID relief? We all know what is COVID. We'll understand what exactly COVID relief is referred to. So it is COVID relief is given by an individual from any person. It could be given by any person. It is given to an individual for what? For COVID treatment of self or family. So what is the condition? All the COVID records. When you say COVID records, the positive report, the medical diagnosis, all of this should be submitted. COVID record should be submitted, and that record should be submitted within 9 months from the financial year end or 31st December 2022, whichever is later. So for every year, this must be submitted. For every year in the case, of course, COVID was already there. So this should be submitted before this date. So once it is submitted, only then they are eligible to claim COVID-19 relief. Now, non-applicability of provision under section 56(2)(10), we said by an individual from any person. Next is member of a family of a deceased person from employer. So employer is giving to employee's family because employee is no more. Employee has passed away. So employer is giving to them. So here there is no limit. Whatever is received is tax-free. Whatever is received is tax-free by a member of the family or deceased person from any other person, not by the employer. It is given by any other person. Then the limit is 10 lakhs. So up to 10 lakhs, it is basically not taxable. And in both these situations, we said the person is no more. Why is the person no more? He's passed away because of COVID, and he received this payment within 12 months from the date of death. And from the date of death, within 6 months, that is, within 6 months, this should have been processed. So whatever is there. So from the date of death, within 6 months, you should have the records in hand. That is, when you say records, the COVID record should be available, and it must be furnished within 9 months. So basically, the amount should be received within 12 months. Record should be maintained. That is, from the time I got COVID, I should have been dead within 6 months. From the time I got COVID, I should have dead within 6 months. After I have passed away, within 12 months, money should be settled to me. I should furnish the relevant documents, the COVID records and everything should be submitted. When I say family member, it includes spouse and children. It also includes dependent parents, brothers and sisters. It also includes dependent parents, brothers and sisters. So next thing that we'll understand is other concepts. So far we understood very critical concepts like dividend, and basically we have understood about casual income. We have understood about your gift. So these are the three broad things we understood. Now we'll understand about interest on securities. Interest on securities, if it's from a bank, 3,500 per post office savings bank account. If it's from a post office savings bank account, up to 3,500, it is not taxable. If it is a joint account, up to 7,000, it is not taxable. And Bhopal gas leak victim is not taxable. Interest on gold deposit bond or gold deposit scheme, anything related to gold, the word gold comes, it is not taxable. Interest on that is not taxable. Interest on bond issued by local authority, state pooled financial ability, tax-free pooled finance development bonds. From these bonds, if you receive any interest, it is also not taxable. All these interests are exempt under section 10(15). So these are the interests that you have to keep in mind. So with respect to this, this is what we are covering about the interest. And then what we are going to understand, what are the expenses? What are the expenses that can be claimed? What are the expenses that can be claimed? So when you say deduction allowable, it says income from dividend. If you have income from dividend or an income in respect of units, you can claim interest expenditure. But maximum of 20% of such income. Maximum exemption that you can get is 20% of such income. Income on interest on securities. Any reasonable sum paid by way of commission or remuneration for the purpose of receiving this. So for the purpose of receiving this interest on securities, if I'm paying any commission or anything remuneration to a banker, I can adjust that with interest on securities. Income from contribution from employer, I'll leave this, I'll skip this. Income from letting out. Generally, income of letting out is covered under house property. Income from letting out is covered under house property. But if a particular rental is so combined that I have also rented out plant and machinery, I have also rented out building. Now it is all consolidated. When it is both consolidated, I am not able to understand how much is plant and machinery, how much is building. It will be covered only from income from other sources. So in case if it is covered under income from other sources, here you don't get that flat 30%. You don't get that flat 30%. So what happens? Whatever is current repair to machinery, plant, furniture will be covered. Any premium paid by insurance, regular depreciation. So if you actually look at it, section 30, section 31, section 32. These three section expenditure or can be claimed in case of income from letting out. And then you have family pension, income from family pension. So family of an employee on death. So whatever is family pension I'm receiving, 1/3 or 15,000, whichever is less. So I am receiving family pension because someone in my family have passed away. So on behalf of them, I'm collecting this family pension. So this family pension is exempt up to 1/3 or 15,000, whichever is less. When I say family pension of a member of armed forces, including paramilitary forces, is exempt. So not 1/3 or 15,000, whatever you receive is exempt if you are in the case of armed forces. Similarly, recipient of gallantry awards. We already saw this in salary itself. So all these Paramveer Chakra, Padma Bhushan, all these award winners, if they're receiving pension or their family is receiving pension, it is eligible as exemption under section 10 clause 18. Any other expenditure not being in the nature of capital expenditure, laid out or expended to wholly and exclusive purpose of making. So any expenditure which is directly attributable to earning that income, can be considered. Then that is section 57. What all can be considered? In short, any expenditure which is relatable to claiming that income can be adjusted. Only dividend, you have a restriction. 20% of income only can be claimed as interest expenditure for claiming dividend. Now, next section that we'll be understanding is section 58. What did we say about section 58? We said expenditure that are not allowed. So there are 3 types of expenses that will not be allowed. First thing is general. General is like section 37. So any personal expense similar to section 37, any personal expense is not allowed. Any interest or salary payment on which tax has not been deducted. So this is similar to section 40A. So 40A. So this is also not allowed. So then next thing is provisions applicable as in provisions of PGBP. 30% of expenditure on TDS non-compliance, similar to 40A only. Excess payment made to relative, 40A clause 2, payment to relative. Any excessive or unreasonable payment will be disallowed. 40A3, any cash expenditure excess of 10,000 will needs to be disallowed. Of course, we saw exceptions. Small business, bank unavailability, salary payments, all these expenses, government, bank, and all these things is of course not allowed. Other than that, if you're making any expenditure in excess of 10,000, that is also considered under income from other sources also. And finally, remission or cessation of liability. So we said till today it is supposed to be due to me. Henceforth, it is not payable by me, then that is not allowed expenditure. So till today, I have to pay someone. From tomorrow, that person says, don't pay me. So then that becomes deemed income, right? So that cannot be adjusted against my expenditure. Third concept, if my business is horse race, that is income from horse race, whatever horse race I'm talking about, the owner of race horses can claim expenditure in respect of owning and maintaining also. Whatever is expenditure relating to owning, maintaining race horses can be claimed. Expenses incurred shall be allowed even in absence of any stake money earned, which means I need not earn income from others, income from horse race to claim expenditure. Even if I'm not having any income, still I'm maintaining my horses for conducting a race at some point in time. So I have to keep claiming my expenditures. So these are all related to income from other sources. The next point that is important is we said section 59. Section 59 is similar to deemed income. So whatever we saw in deemed income in 41, that is remission or cessation of liability, recovery of bad debts, all of this is applicable in 59 also. So whatever we discussed in section 41 will also be applicable for section 59. So with that, what happens is we have actually covered income from other sources. So we have now covered all the heads of income. What I will do is few things which I want to reiterate, will be taken up right now, and I've clarified 10 things. That is basically one thing that about this 112A is about calculation of this, whatever is the cost of acquisition. So whatever is the cost of acquisition needs to be considered. So what did we say? Fair market value or sale consideration, whichever is lower. Now that is compared with cost of acquisition, whichever is higher. Here, what are we saying? My cost of acquisition is 100. My sale value is 250. My fair market value on 31st January is 200. Now, first exercise is to compare these two, 200 and 250. I'll take what? I'll take whichever is lower. So my lower is 200. Now I compare 200 with 100. 200 and 100. Now I take whichever is higher. So 200 becomes my higher thing. So my sale value is 250. My cost of acquisition will become 200. 200. So my capital gain will be 50. My capital gain will be 50. In the next case, I again take difference of these two, fair market value 150 and sale value to sale, fair market value is 200, sale value is 150, whichever is lower. So I take this 150. So I take 150. I take 150, 150 or 100, whichever is higher. What will be higher? 150. So now 150 will become my thing. So what will be my capital gain? 150 minus 150. 150 minus 150 will be nil. What about C? My sale value is 150. My fair market value is 50. Whichever is lower. So I'll take whichever is lower. Whichever is lower is 50. Correct? Whichever is lower is 50. 50 or 100, whichever is higher. 50 or 100, whichever is higher. So I'll take 100. So my sale value is 150. My cost of acquisition is 100. So I made a capital gain of 50. Now next thing is my sale value is 50. My fair market value is 200. My sale value is 50. My fair market value is 200. So whichever is lower. So of course I'll take my 50 as my lower thing. Now 50 or 100, whichever is higher. Now my thing will be 100. So I'll be making a loss of 50. That is 50 minus 100 is I'll make a loss of 100. Next one is automatically what is happening? 250 is my sale value. Fair market value is 200. So out of 250 and 200, whichever is lower. So automatically what is happening? My 200 is what I'll take. 200 or nil, whichever is higher, I'll take 200. So 250 minus 200, 50 will be my value. And last one, my rights value is 10. My sale value is 50. My fair market value is 200. So now automatically what will happen is 50 or 200, whichever is lower. Correct? Whichever is lower. So I'll take 50. And my 50 or 10, whichever is higher. So I'll take here. So my will be nil. So my total value will be basically nil for this also. So that is what it's about, calculating of capital gain. So with respect to fair market value of long-term capital gain, it is important to understand these particular situations. Correct? So that is as far as your thing is your capital gain is concerned, how to calculate the fair market value. Similarly, in slump sale also, we took up a formula. We said aggregate value of assets will be additions of all these things. So it is important to understand these. It is also important to calculate FMV1 and FMV2. So that is also important. So these are also critical type of calculation. These all involves calculation to understand what exactly is your capital gain. So fair market value, all these four assets will be taken into consideration. I said the depreciable asset, nil in case of thing, goodwill in case of thing, and book value in case of any other asset. So that is also should be considered. And whereas in depreciable asset, it's simple, net sale consideration thing. And why do I basically do this is, generally when I'm calculating my WDV, what will happen is, when I'm calculating my WDV, I'll have my opening WDV plus additions minus deletion. I get closing WDV. So I'll apply depreciation on this. So when my opening WDV is if my closing WDV, that is the value of deletion, value of this is greater than opening plus additions, opening plus addition, then I'll recognize capital gain. Then I'll recognize capital gain. So this is the first situation. Second situation, sell all assets in block. So that is also capital gain. So these are the two situations I will raise capital gain. So that's what we are saying here. First situation is consideration greater than WDV, where my net sale consideration is more than opening WDV plus cost of asset acquired during the year. Whereas in the second situation, all the assets ceases to exit. And what will be my sale consideration? I'll take the sale consideration less cost of acquisition. Cost of acquisition is nothing but opening WDV plus additions. My cost of acquisitions will only be this much. So that is what we are covering here. So these are the things that are important to understand when you're calculating about your capital gain concepts. So with other than that, if I have to tell you something more on this, yeah, in this, we were also talking about this 43 CA differences. It is 100 or 110. So there are several sections, 43 CA, 50 CA, all talks about this only. So we said, if some part is received in cash or something, then it automatically becomes what? Which date to take? Stamp duty value, which date to take? The stamp duty value is taken based on the date of agreement. It is when at least some part of money is received. Some part of money is received as banking mode. Some advance is received in banking mode. Then I take the date of agreement. Otherwise, take a date of registration. So I compare as 110%. So in the first case, actual consideration is 100 and it is paid through RTGS. Stamp duty value is 120. Stamp duty value on date of registration is 120. Since it's RTGS, I have to consider only the stamp duty value on the date of agreement. 110% of 100 is 110. So 110 or 120, whichever is higher. Which is higher? 120 only. So I will go by 120. Next case, 100, but it is received in cash. And so I will have to take the date on the date of registration, 130. So 100 or 130, 100 into, of course, 100 into 10%. 110% will be 110. So 110 or 130, whichever is higher, I'll take 130 only. In the next case, it's also RTGS. So I will take the date of agreement. Here it's only 109. So 100 into 110% is 110, which is less than 109, which is less than 109. So what will be my sale consideration? My sale consideration will be 100. In the last case, 100 is fully received in cash. So this is relevant, 130 only. So into 110% is 110, 110 or 130, whichever is higher. So I'll take this as the stamp sale value consideration. So for the calculation of PGBP or calculation of capital gain, I follow this approach. I follow this approach to understand what exactly will be treated as my capital gain as such. So this is what is important with respect to your business or profession also. And as I told you, in this situation, that is excess of fair market value. Here also we were talking about an example. So we took about several cases. Second case, we straight away said it is not applicable because B Limited is a public company. So this is only applicable for private limited where shares are issued more than the fair market value. In first situation, A private limited is issuing 10,000 shares. Face value is 100. Fair market value is 120. Issue price is 130. So now fair market value is less than the issue price, which means the excess, that is 130 minus 120, that is 10, will be treated as income, because my issue price is more than the fair market value. My issue price is more than the market value. Second case, we said it's not applicable because it's a public limited. So third case, face value is 100, fair market value is 90, issue price is 100. Now, this is not issued at premium. Because 100 is issued at 100 only. So there is no income here also. No income that will be taxable under section 56(2). The fourth one is D private limited. Again, 100 is fair face value, 110 is issue price. But what is the fair market value? Only 90, which means my issue price is more than the fair market value itself, more than the fair market value itself. So the difference here also will be treated as income. Difference between 110 and 90 will be treated as income, My issue price is 110, my face value is 100, my fair market value is 120. Here my fair market value is greater than the issue price. So here also no income. So this is how you actually calculate excess of fair market value. In your as such, income from other sources, you'll be questioned on dividend. One thing I would like to tell you about this dividend or interest is dividend. Okay, dividend will have the word bracket net or sometimes gross. So for example, if it says net amount is 5,400. Okay, 5,400, which means the net dividend is 5,400, which means dividend is after TDS. For dividend, the TDS rate is 10%, which means this 5,400 is 90%. 5,400 is equal to 90%. So I identify what is it for 100%. So how do I do cross multiplication? So 5,400 divided by 90% into 100%. It will be 6,000. So my actual dividend is 6,000. Though the question talks about 5,400, my dividend that I'll be taking for the purpose of computing income will be 6,000. In TDS, I will consider that 600. So this is what the importance of net. Similarly, in house property, the question uses the word computed. That is, in house property, if the question uses the word computed, okay, if the word's computed, which means 30% standard deduction is already provided. In case if the word is not given, then you have to provide 30% standard deduction. Same way in salary. If salary uses the word computed, then it means standard deduction of 50,000 is provided. In case if the word is not provided, provide standard deduction of 50,000. So these are critical things. Similarly, in income from other sources or everywhere, look for the word net or gross. When you say gross, which means it is before TDS, you have to take it as it is. But if the word is net, you have to back work. As I told you in the example that we took dividend net is 5,400, which means 5,400 is equivalent to 90. How much is equivalent to 100? So I will cross multiply. So 5,400 into 100 divided by 90. It will give me 6,000. So 6,000 is my dividend income, not 5,400. So these are critical things that I have to take it into consideration while I'm working out these chapters. So these are what I have to keep it in mind. And similarly, whatever is there, things like where I say deduction chapter 6A is not available. For example, if we saw 3 sections, right? Capital gain, we saw 3 sections. 111A is STCG. 112A is LTCG. 112 is also LTCG. Okay. In all these 3 things, we said 6A deductions not applicable. Then non-resident basic exemption limit, it is not available. And then finally we said rebate 87A allowed. It is not allowed only in a long-term capital intersection. So these things you have to remember like a table. So that you link. Similarly, for your casual income, also what did we say? No chapter 6A interest. Here it is also for resident. Resident also basic exemption limit is not available. So not only for non-resident, it is not available for anyone. So and similarly, no expenditure can be calculated. So you have to keep this in mind. Straight away 30%. I can't take anything into consideration. I just like that consider whatever is taxable. So please remember these things in mind. Keep it in mind, whatever is thing. So whatever model we are talking, whatever formula we are talking, keep that in mind so that you are able to easily link it. The entire exercise of this session is to keep it simple, to keep it what is important for examination. So that is how it has been covered. So that is how we have covered all the 4. So now we have covered all the 5 heads of income, all the 5 heads of income. Yesterday we covered salary. Today we have covered 4 heads of income, right from your house property, PGBP, capital gain, and other sources. All the heads of income have covered. Whatever is important, whatever is critical for examination have been covered. The balance portion will be taken up tomorrow and covered it in detail. So with this, I'll close this session for today. We will see tomorrow with the balance chapter. With tomorrow, we'll be done with our marathon session. So thank you for the wonderful session. So of course, I would have been rushing it through, so you can stop then and there where you want, or probably replay and see it again and again, so that you are grasping the provision as it is. So with that, I'm done with my session. So we'll meet tomorrow.
Thank you so much, sir. That was a very interesting and useful session. Looking forward for your next session tomorrow. Thank you so much, sir.
Yeah, thank you so much. Yeah.